Hi, my dear students. Good morning, good afternoon, good evening, good night, at whatever time you are watching. So, this is CA Tofik Tufail, and we are here one more time for a very exciting video. And in this, so this is a mighty 50 question revision. In the last video, if you haven't watched the last video, please watch it. We have completed the section A, which is investment decision, that usually comes for 25 to 30 marks. So now we are coming on to the next part or the next section, which is security analysis and portfolio management. Now the security analysis and portfolio management usually comes for 35 to 40 marks. So that is the weightage which is allocated in the examination, sometimes 35, sometimes 40. So usually 35 to 40 marks will come under section B. If you cover section A and section B, you have covered 60 to 65 percentage weightage. So 60 to 65 percentage weightage is completed if you cover cumulatively section A and section B. So these two chapters are like the category A chapters of CMA final. Sir, in this video we are entirely going to cover the security analysis and portfolio management. Sir, how are we going to cover? See, I have handpicked a lot of comprehensive questions. So how in the last video I have covered 11 questions, right? So in this video I have taken one more around 18 to 20 questions which are completely covering all the concepts of security analysis and portfolio management. Okay. So let me just show you. I will also attach the PDF in the description. So section A that we have already completed. Now we are going to start with section B. In this section B, it starts from question number 14 and it ends at question number 28. So 14 to 28, around 15 questions we are going to cover in this security analysis and portfolio management, that will have an entire coverage of equity valuation, bond valuation, mutual funds and portfolio management, portfolio management, minimum variance, capital market line, everything that we are going to cover in these questions. See, this is a technique of revision where we are going to cover the concepts with questions. So first we are going to see the concepts and then we are going to see how the question will come from those concepts, and all the questions are comprehensive and either asked in the examination, it has been taken from the study material, workbook, past exam questions, etc. Okay, sir, directly jump on. Okay, we will directly jump on to the security analysis and portfolio valuation. So just for the coverage perspective, I want you to show what and all is included in security analysis and portfolio management. Sir, part number 1 is equity and bond valuation. Part number 2 is mutual funds. Very, very important. 1 or 2 questions, 100% asked from mutual funds. Portfolio theory and practice. Okay, again a very, very important. Definitely 1 or 2 questions are asked. Asset pricing theories and portfolio management evaluation and portfolio revision. Again, this is very important. 1 or 2 questions are asked from these. So these are the important areas from where a lot of questions are asked. Efficient market hypothesis is a theory part. You just have a reading of what is efficient market hypothesis. It shows that market are always efficient. There is no imperfection in the market. So that is what is this hypothesis is about. So you have a reading. So theory I am not covering for the revision purpose. So I am covering the concepts plus the questions. So this is a mighty 50 question revision that we are uploading in parts. So we are going to cover all the questions with the concepts, and I have also written you some notes. So I am also going to share you this notes. With this notes we are going to cover everything with the questions. So listen to this video. I am not going to solve all the questions in writing. In fact, I am going to dictate the answers and you are going to listen for the sake of revision. Okay, fine. So let us start with mutual funds. Okay, let us start with mutual funds. Sir, what is mutual funds? Okay, so first we will cover the concepts and then takkana we will go into the questions without wasting any time. So I also want you that the time that you are spending here should be 100% effective. Sir, mutual funds. What is mutual funds, sir? The individual investors, the individual investors will invest in the mutual funds. Okay, the individual investors will invest in the mutual funds, and mutual fund is what, sir? It is a trust. So for example, I am a trust, so I am going to take contribution, or I am going to take amount from the individual investors, and in return I am going to invest in the capital market. Now from the capital market, what I will get? From the capital market I will get interest. Okay, from the capital market I will get interest, I will get dividend, I will get capital appreciation. Are you all with me? So what will happen? I will receive some income and I will distribute that income to individual investors. So how they are going to purchase? So it is called as units. So what will happen? Individual investors will pay some money to the mutual fund, and mutual fund will in return give the unit. Sir, what is the unit, sir? The unit is nothing but they will sell at NAV, net asset value. What is net asset value, sir? It is nothing but the market value of the current investment that they are having. Okay, sir, basically if I'm having four friends, so four friends individually they are investing, individually they are using their brain, so it will be difficult for them to track everything. So what I thought is that, see, I will manage all your four people's money. So you guys give me 1 lakh rupees, so all my four friends will give me 1 lakh rupees and I am going to manage. So let us say I've invested 4 lakh rupees. After 1 year that 4 lakh rupees became 5 lakh rupees. Assume no dividend received, no nothing received, so totally the market value increased to 5 lakh rupees. So now what will happen? Either I can distribute that 1 lakh rupees to them, either I can distribute that extra 1 lakh rupees that I earned to them, but I have not sold it yet. Then how will I distribute? So what will happen? I will tell that, see, you have invested 4 lakh rupees, but the value of that 4 lakh rupees is 5 lakh rupees. Are you all with me? For example, let us say that 1 unit is equal to 1 rupee. Each person is having 1 lakh units. Sir, why are we multiplying it, dividing it into units? Because then I can track what is the price of the unit at the time of investment. Okay, at the time of investment, my per unit price was 1 rupee. So let me just write down in the notes. Okay, so 1 rupee is equal to 1 unit. Now in this 1 unit, what has happened? I have totally raised 4 lakh units. So which means I got 4 lakh rupees at the start of the year. Let us say at the end of the year, this 4 lakh rupees become 5 lakh rupees. Now once this became 5 lakh rupees, what will happen? My 1 rupee unit, now it has become how many units? So this is 5 lakh divided by 4 lakh. So 5 lakh divided by 4 lakh if I do, which means my per unit price is 1.25 per unit. So this is what is called as NAV. So the concept of net asset value. Previously my net asset value was 1 lakh rupees. Now my net asset value is 1.25 rupees. Suppose a fifth investor wants to come in. A fifth investor wants to come in at this point. So we cannot tell, pa, he invested 1 rupee, I will also give you 1 rupee, you give me 1 unit. You cannot tell that, because at the time of his investment the value was 4 lakh and now the value is 5 lakh rupees. So now whenever a new investor wants to come in, he has to give rupees 1.25, or we can also say the otherwise, if at all an existing investor wants to sell, so he can sell it as 1.25 rupees and then he can come out and take his profit. Are you all with me? So this units are also traded into the market. It is also one type of security. Mutual fund is also one type of security. So just to illustrate, okay, the concept of NAV, I know that you all know, but just to illustrate the concept of NAV so that the next concepts become easy. Sir, okay sir, what is net asset value? Net asset value means value of per unit. Sir, what is the value of per unit? The market value of the securities invested. Sir, which means NAV is equal to net asset value of fund divided by number of units outstanding. Okay, number of units outstanding. Sir, what is, so net asset value of the fund divided by number of assets units outstanding. So here this is the net asset value of the fund. For example, securities is the fund. Now let us say we also have some cash. Let us say 5 lakh rupees and we also have some 50,000 rupees cash. So we have only invested 3 lakh 50,000, 50,000 we have kept as cash. So which means that is also forming part of the asset. So 5 lakh plus 50,000, whatever is the asset, basically total assets minus the liabilities is equal to net asset value of the fund. Okay, sir. So what is net asset value of the fund? The market value of investment plus receivables, okay, plus receivables plus accrued income plus other assets plus accrued expenses minus payable and minus other liabilities, okay, minus payable and minus other liabilities, okay, minus payables and minus other liabilities. So these are the net asset value of the funds. Sir, this is the concept, sir, net asset value. Okay, net asset value is the concept, which is nothing but net asset value of the fund divided by number of units outstanding. Sir, what is net asset value of the fund? The market value of investment plus receivables plus accrued income plus other assets plus minus accrued expenses minus payables minus other liabilities. Basically it is nothing but asset minus liabilities. Okay. Sir, next one, what is the return from the fund? If someone is asking what is the return from the fund, it is nothing but NAV at the end minus NAV at the beginning, plus any dividend or interest which I have received, plus any capital appreciation that I have received, divided by NAV at the beginning. For example, if someone wants to know what is the return that I have earned, so what he will do, sir, my NAV at the end was 1.25, my NAV at the beginning is 1 rupees. And I have invested how much? 1 rupees. So which means I have earned 0.25 rupees on 1 rupees. Okay, I have earned 0.25 rupees on 1 rupees, which means that my return is 25%. Are you all with me? Someone is asking you what is the return? My return is 25%. So this is what is the formula. Suppose they have also distributed some dividends, so that is also the income. Let us say that 1 rupee distributed as dividend, so this becomes 1.25 and then my return is 125%. Clarity. So this is how the NAV concept works. Okay, sir. So what is NAV, sir? NAV at the end minus NAV at the beginning, which is nothing but what is the increase in NAV plus any dividend or interest distributed plus any capital appreciation distributed. So distribution is also my profit. So distribution can be in form of dividends, distribution can be in form of capital appreciation. Okay, so divided by NAV at the beginning. Sir, what is the annualized return? See, this return from funds can be from any period, point A to point B. But we, if at all we want to compare, we have to compare with annualized return. Suppose the return of fund is only for 30 days. So this is only for 30 days return. Now what we have to do, annualized return, the return from the fund divided by period of the return into 12 months or 365 days. Okay, let us say that this 25% that we got, right, this 25% that we got is only for the period of 6 months. Sir, what is the annualized return? The annualized return is return from the fund divided by period of the return into 12 months or 365 days. So this becomes 50% is the annualized return. So we can write it as per annum. So now I can compare. Okay, so this fund is giving me per annum 50%, that fund is giving me per annum 30%. Therefore, I will go with fund A or fund B. So this is what is annualized return. Okay, so with this, okay, with this, let us try to cover the questions. Okay, let us try to cover the questions. So section B, if you haven't watched section A, please watch it, because lot of important chapters we have covered, and there I have solved the question one by one. Okay, there I have solved the question one by one, because I thought that that time should be invested to solve. But now I have not solved it. Now I will not be going to solving this question. I am going to dictating this question. Okay, so let us go to section B. Okay, section B, and let us see this. Mr. Sinha made an investment in mutual fund when the net asset value was 14.5 rupees. So 14.5 rupees he made an investment. 90 days later, the asset value per unit fund becomes 14.25. So 14.50 becomes 14.25, which means there is a reduction. Moreover, in the meantime, Mr. Sinha received a cash dividend of 0.6 and a capital gain distribution of 0.4. So this is the distributed income that he received. Compute the monthly return. Okay, so this is something that we have to see. They are not asking return from the fund, they are asking monthly return. Clarity? Super. Sir, how to solve this? Okay, how to solve this? See, the first one, okay, roughly I'm just telling. First one, you all know what is the formula. What is the formula for return from the funds? NAV at the end minus NAV at the beginning plus any distributed income divided by opening NAV. Okay, suppose, sir, what is my NAV at the end? What is my NAV at the end? 14.25. What is my NAV at the beginning? 14.50, which means there is a 0.25 reduction. Okay, NAV at the end and NAV at the beginning. So there is a reduction. Plus, what is the income that I am receiving? 0.6 and 0.4. Okay, which is nothing but 1 rupee. And how much I have invested? 14.50 I have invested, correct? I have invested 14.50. That is nothing but the opening NAV. So this is the return from the fund. So what is the return from the fund? So 14.25 minus 14.50 is minus 0.25. Okay, it is minus 0.25 plus 1 is equal to 0.75 divided by 14.5 into 100 is equal to 5.17 percentage. So this is what is the return from the fund. But now I should not see this return because the question is not return, the question is monthly return. So this is for what, how many days? This is for 90 days. Sir, this return is for 90 days. This is not per annum, this return is for 90 days. Now sir, they are asking monthly return. See, two ways you can do, okay? The one way is directly you can do 5.17 is for 90 days now. For 30 days how much? Clarity, for 30 days how much? Because 30 days is the monthly return. Are you all with me? So what you can do, divided by 90 into 30 is equal to 1.72 percentage per annum. Either you can write it like this, okay? Either you can write it like this, or how you can do, first try to find out the annualized return. Sir, how to do the annualized return? This 5.17 is for 90 days. How much is for 365 days? Okay, how much is for 365 days? So 5.17 divided by 90 into 365, it is equal to 20.967 percentage per annum. So this is what is called as the annualized return. Okay, this is what is called as the annualized return. Now from this annualized return, just do divided by 12. So that is what is the monthly return, which is 1.74 percentage. Sir, why there is a difference? The difference is because here you have taken 365 days, here you have assumed 360 days. That is only difference. Okay, in the study material it is solved like this, but even if you solve it like this, there is no problem. But my suggestion is that you solve it like this, because annualized return is a concept. Show to the examiner, I also know the concept of annualized return. Clarity. So this is what is the solution. Okay, this is what is the solution. Sir, first one, return from the fund. Sir, NAV at the end minus NAV at the beginning plus dividend plus capital appreciation divided by NAV at the beginning. Sir, 14.25 is the NAV at the end. Okay, 14.25 is the NAV at the end. Sir, 14.25 is the NAV at the end minus 14.5 NAV at the beginning plus 0.6, it is nothing but the dividend that I received. 0.4 is the capital gain that I received, divided by 14.5. Sir, how much I'm getting? I'm getting 5.17 percentage. Okay, that is what we got here, 5.17 percentage. Now sir, this 5.17 percentage, I am first annualizing it. So what is the annualized return percentage? Return from the fund percentage divided by period of return, which is 90 days into 365 days. Sir, what is my annualized return? 20.977 percentage. Okay, accurate, 20.977 percentage, which means what is my monthly return? Annualized return divided by 12 is my monthly return. So my monthly return is 1.748 percentage. I hope you all are having this clarity. Sir, simple problem, sir, but it has been asked in the examination. Okay, it has been asked in the examination. People will do a mistake. Okay, people will do the mistake of not reading this as monthly return and not seeing this 90 days, directly doing the problem 1.77. They will put something, okay, 5.17, and then they will put the answer, and then you will not even get a single mark. So always reading the question is more important than solving it. So next one, question number 15. Question number 15 is a beautiful problem. Okay, it is a beautiful problem, and I am very much thinking that this problem, this question number 15, this is an exam, like this is the pure proper problem that should be tested in the examination. And there is one more problem like that, like this question number 18. These two problems are like repeatedly asked in the examination. Sir, question number 15, sir. Question number 15. Let us try to read this. This is a little bit lengthy problem, so you have to be with me. But once you know how to solve this problem, this is one of a kind problem. Only if you solve it, you will be able to get this. Otherwise, you will not able to get this answer. So please concentrate. Sir, Mr. Ajay, on 1/7/2020, during the initial offer of some mutual fund, invested 10,000 units having a face value of rupees 10 per year. So which means he has invested 1 lakh rupees on 1/7/2020. By that he has taken 10,000 units. On 31/3/2021, the dividend operated by the mutual fund was 10%. So which means they have distributed 10% dividend. And Mr. Ajay found that his annualized yield was 153.33%. Okay, his annualized yield was 153.33%. Okay, annualized yield. On 31/12/2022, 20% dividend was given. On 31/3/2023, Mr. X redeemed all of his balance 11,296.11 units when his annualized yield was 73.52%. What are the NAVs on 31/3/21, 31/3/22 and then 31/3/23? Very interesting question. By reading, it looks like it is an easy problem, but it is not that easy problem when you are going to solve it. Okay, sir. So whenever you get a problem like timelines, always first draw the timeline. Okay, always first draw the timeline. Okay, sir, when he has invested on 1/7/2020. Okay, 1/7/2020. You want to find out the NAV as on 31/3/21, 31/3/22 and 31/3/23. Okay, so 30, 21, 22, 23, 21. Okay, 22 and then 23. Okay, sir. So 31/3/21, 31/3/22 and then 31/3/23. You want to find out the NAV for these years. Okay, just a moment. Okay, sir, now just write the question first. Okay, just write the question first. How much units I have purchased? 10,000 units I have purchased. What was my NAV? My NAV was 100 rupees, correct? My NAV, sorry, 10 rupees. My NAV was 10 rupees. Okay, so this is what is the NAV. Sir, Appa, what is my value of investment? 1 lakh rupees is my value of investment. Till now, are you all with me? Super. Now, sir, what is telling? My annualized return, and they have paid dividend of 10%. See, always dividend percentage given, it is always on face value. So 1 rupee dividend they have given on 31/3/21. So during the year 21, your dividend was 1 rupee. During the year 22, your dividend was 2 rupee. That is what they have given, because as on 31/22, 20% dividend was given. So 31/22, 20%, and here no dividend because nothing has been given. Clarity? This much clarity you should be having. Okay, but this is the NAV. Super. Sir, now what else is given in the question? My annualized yield as on 31/3/21 was 153.33%. So this is 153.33% per annum. Sir, why are you writing per annum? Because this is my annualized yield. Sir, next one, what they have given? I have redeemed my balance on 31/3/23 of 11,296.11 units. So on 31/3/293, my 10,000 units become 11,293.11 units. Sir, how, sir, the units are increasing? Which means here we have to take the assumption that they are not distributing this dividend. They are actually reinvesting the dividend by providing them the units. Are you all with me? So they are redistribution the dividend. That is the only point that you have to know while solving this problem. Then this problem becomes very easy. Super. Okay. And what is the annualized yield? 73.52%. Okay. So 73.52% per annum. This is what is given in the question. This much clarity you are having. This is what is given in this question. Now, sir, how to solve, sir? Okay, how to solve, sir? Go step by step. Okay, here roughly I am solving. Okay, go step by step, sir. Now, sir, the first step, I know my annualized return. I know my dividend. Okay. I know my opening NAV, which means I can find out my closing NAV. Are you all with me? Okay, sir. First thing, okay, well, first thing, 1722 31 321. What is the, okay, 1722 31 321? What is the number of months? 7, 8, 9, 10, 11, 1, 2, 3. Okay, so this is nothing but 9 months. So first, can I find out the 9-month return? Can I find out the fund return? Okay, so first it is nothing but fund return in percentage I want to find out. Okay, fund return percentage and find out. Sir, how we can find out, sir? You know the annualized return, 153.33 percentage per annum is the annualized return. If this is for 365 days, what is, or let me do divided by 12 into 9. Okay, let me do divided by 12 months into 9 months. Nothing but annualized return formula only. Annualized return is equal to fund return divided by period of month into 12 months or 365 days. You just swap it down, you will get the fund return. So, what is my fund return, sir? 153.33 divided by 12 into 9. You are getting 115 percentage, which means, sir, my fund has given me 115 percentage, which means this 1 lakh rupees has increased by 115 percentage. Clarity, which means 1 lakh rupees has increased by 115 percentage. So my value is 2,15,000 rupees. This much clarity you are having. Okay, sir, which means what is the value of my fund? Value of fund as on 31/3/21 is equal to 1 lakh into 115 percentage, which is nothing but 2,15,000 rupees. This much clarity you are having. Super. Sir, 2,15,000 rupees is the value of the fund. Are you all with me? And I received 10,000 rupees as dividend. Correct? 1 rupee dividend per unit. So which means 10,000 units I'm having. Are you all with me? So 10,000 units I'm having. 10,000 rupees dividend I got. Clarity. Sir, now I want to know, okay, now I want to know how much are my number of units. Okay, how much are my number of units, sir? Now everyone, what is my return? First one, 1 lakh, 2,15,000 and 1 rupee. So my dividend is equal to, okay, my dividend value is equal to 10,000 rupees. Are you all with me? My dividend value is equal to 10,000 rupees. And whatever I'm solving here, okay, don't worry. I've given the answer here. Okay, I've given the answer here. The same thing I've written here. Okay, 10,000 units. Oh, sorry. So 10,000 units, sir, 10 rupees. Okay, 10,000 units. 10,000 units, sir. 10 rupees on 1/7/2020, 31/3/21, 31/3/22, and 31/3/23. 1 lakh rupees it is given in, okay, so 1 lakh rupees is given in the question, and 11,296.11. Sir, first one, what is my annualized return? Working note number 1, my annualized return is return from the fund divided by 9 months into 12 months. So my return from the fund is 115 percentage. Point number 1. Sir, point number 2, sir, what is the return of from the fund this 9 months? Sir, how this formula is coming? NAV at the end minus NAV at the beginning plus dividend divided by NAV at the beginning. This is what is the formula. Clarity, sir, which means this 115 percentage is nothing but NAV at the end. My NAV at the beginning I know, which is 10 rupees, plus dividend 1 rupees, and NAV at the beginning is 10 rupees. All unknown, one unknown. Okay, so all known, one unknown. So my NAV at the end is equal to 20.50 rupees. Are you all with me? So it is 20.50 rupees. So this is how first you will find out what is my NAV as on 31/3/2021, which is nothing but 20.50. Now a very important part, this 1 lakh has become 2,15,000 and my NAV is 20.50. So how many units I am having? The units is 10,487.8. This much clarity you are having. Sir, fund value as on 31/3/21 is 2,15,000 rupees. My number of units is nothing but value divided. Okay, 2,15,000 divided by 20.50, which is nothing but 10,487.8 units. This much clarity, if you guys are having, half the problem have been solved. Now let us come to the second half of the problem. Okay, first half of the problem bit easy, second half more thinking is required. Okay sir, till this, okay, till this you have completed 10,487.8 units. Sir, how sir 10,000 is becoming 10,487.8 sir? So which means this 487.4 487.8 units extra, from where it is coming sir? It is coming from this dividend. You do one thing, take out your calculator. This 1 rupee dividend I'm getting for 10,000 units, correct? So this 10,000 dividend I'm getting, this 10,000 divided by what is my NAV, which means how much I didn't receive dividend, instead of dividend I received units. So 10,000 and what is my dividend, what is my NAV, divided by 20.5, you will get 487.8. Are you all getting this? Okay, 487.5. So that is how I'm getting this. Okay, that is how I'm getting this, which means my dividend. So this is my dividend reinvestment. This is an assumption. Okay, I'm just showing you. So 10,000 rupees is my dividend divided by 0.50. So 487.80 units have been added. This much clarity you should be having. Are you all with me? Super. Now, sir, next 11,296 units. 0.11 units you are having as on 31/3/2023, which is given. No dividend information is given in the year 3, which means no dividend reinvestment in year 3. It means my number of units 11 becomes the same, 11,296.11 units. Point number 1. Are you all with me? So here also I will be having 11,296 units because no dividend. So no dividend means no dividend reinvestment. Point number 2. Sir, next one, what we are doing, how much is the additional units that I received for dividend reinvestment? Because now this part is completed, now we want to find out the NAV for this. So how much is the additional units? Okay, how much is the additional units I got for dividend reinvestment? Sir, I got 11,296.11. okay, 11,296.11 minus 10,487.8. So 808.31 units I got. 808.31 units I got for 20,000 rupees of dividend. So with this I can find out the NAV. This much clarity you are having, sir. Sir, what sir? Sir, how much units I'm getting? 808.20 units I'm getting. Okay, 808.20 units I'm getting. Sir, how much dividend I am receiving this time? I am receiving this time, how much units I am having? 10,487 units I am having. I am receiving 2 rupees dividend. So 10,487 into 2, okay, this is what is the dividend, divided by the number of units. If you do, you will get the NAV as on the end. Okay, so additional units for dividend reinvestment is 808.20 units. So 104 is 10487.80 into 2 rupees. This is nothing but the dividend amount. Dividend amount divided by the closing NAV is equal to 808.20 units, because this you already know. So which means your closing NAV is 25.95 rupees. Are you all having clarity? Sir, you want me to solve? See, very simple. Okay, see, very simple. You have found out that the value of the fund is 2,15,000 rupees. Now this you already know. What is the fund return? Okay, what is the fund return? This 115% is nothing but NAV at the end. NAV at the end only you don't know. Okay, NAV at the end you don't know. NAV at the beginning. Okay, plus your dividend reinvestment is 1 rupee divided by 10. So if you do this, you will get the NAV. Sir, how much is the NAV, sir? 115. Okay, so 10 into 115% is equal to 11.5. 11.5 and you just do here like this. So 11.5 plus 10 minus 1, so which is nothing but 20.50. This is your NAV as on 31/3/2021. okay, 31/3/2021, which is nothing but 20.5 rupees. Okay, so 20.50 rupees. Now sir, if my NAV is 20.50 rupees and my value is 2,15,000 rupees, okay, and my value is 2,15,000 rupees, okay, 20.50, so which means how much units I'm having? Okay, so number of units is equal to, my fund value is 2,15,000 rupees. So 2,15,000 rupees divided by 20.50, 2,15,000 rupees divided by 20.50 is equal to 10,487.8 units. So this is 11,293, no dividend. So this also 11,000. Okay, this also 11,293.11 units. Sir, how you got this 487 units, sir? You already know that I got 10,000 dividend. So 10,000 dividend divided by NAV at the end. Okay, 10,000. So it is nothing but dividend amount divided by NAV at the end. Okay, dividend amount divided by NAV at the end. What is my NAV at the end? 20.450 units. So which is coming to how much? 487.8 units. Okay, 487.80 units, which is nothing but units for dividend distribution. Okay, units for dividend distribution, or it is also called as reinvested. Okay, reinvested units for dividend distribution. Sir, this much you got, sir. So which means you got some 487 units here. Okay, but you got some 487.8 units here. Sir, how much additional units you got? Because you know this amount, so directly you can calculate. Okay, so directly you can calculate 11,293.11 minus 10,487.8. So which is nothing but you got how much? 805.31 units I got for the dividend. Okay, I got for the dividend. What is the dividend amount, sir? Here my dividend amount is 10,000. Here what is the dividend amount, sir? Here dividend amount is 10,487. Okay, 10,048, sorry, into 2, right? 2 rupee dividend I got. So it is nothing but 10,487.8 into 2. So 10,487.8 into 2, which is equal to 20,975.6. So 20,975.6 is the dividend amount. And my dividend units is how much? 805.31. So if you just do divided by 805.31, you will get the NAV, which is nothing but 26.05. Okay, so your NAV is 26.05. This is what you will get here. Okay, this is what you will get here. Wait, divided by 808.20, right? Divided by 808.20. 11293.11 minus 10487.8. 11,296.11 minus 10,487.8. 808.31. 808.20. One minute. 11,296.11 minus 10,487.8. Okay, this is nothing but 808.31 units. No worries, it is just a small round off. So even if you do 31, your answer will not change. Your NAV will be 25.95 rupees. Now this 808.20 rupees, if you do 10487 into 2 divided by 808.31, you will get 25.95. I got something like 5 paisa difference. Okay, 26 I got. Okay, so 5 paisa difference. This is nothing but a small rounding off mistake here. Otherwise this is 808.31. if you do 808.31, you will get 26 rupees. Okay, some 5 paisa extra, so 26 rupees. That is what is the NAV as of 31/3/2022. Sir, if this is the 31/3, then what is the fund value? Your fund value is, okay, your fund value is number of units into the closing NAV, which is nothing but 2,93,134. Not asked, but we are just calculating. Now sir, the next one. Okay, now sir, the next one, what is the, okay, now what is the NAV as on 31/3/2023? How we can find out, sir? See how we can find out. We know what is the annualized return. So using the annualized return, first to calculate the fund return. How, sir? Because the fund started from here. So from here it has ended to here. So annualized return, we will convert it into the fund return. Then we will see 1 lakh will become what? Okay, 1 lakh will become what at an annualized rate of 73.52%. Are you all with me? So what we are going to do is 73.52 52 percentage that we are having, right? 73.52 percentage is the annualized return. (73.52% is the annualized return. Now we are calculating the fund return. Sir, what is the fund return, sir? 73.52 is for 12 months, correct? Or I can put this is for 1 year. I want to find out the return from first 1/7/2020 to 31/3/2023. Sir, which means what, sir? Which means here 9 months, okay, here 9 months, okay, which means here 9 months, here 12 months, and then here 12 months. So this is becoming 24 plus 9. 24 plus 9 is equal to 33 months, okay. 24 plus 9 is equal to 33 months, or 33 months divided by 12 is equal to 2.75 years. Okay, you do divide by 12 into 33, or if you do into 2.75, it is okay. So into 73.52, so my fund return is 202.18 percentage. This is what is the fund return for 2.75 years, sir, which means 1 lakh rupees is becoming how much? 1 plus 202.18 percentage, which means 1 lakh rupees plus 202.18 percentage. I am getting 3,02,180 rupees. Sir, if this is my fund value, and I know number of units also, NAV is nothing but, okay, NAV is nothing but, okay, net value divided by number of units. Sir, what is my net value? 3,02,180. How much number of units I'm having as on 31/3? 11,296.11. 11,296.11. So if you do divided by 11,296.11, so 3,02,180 divided by 11,296.11, you will get 26.75, and that is what is the answer, 26.75. okay. So a very easy problem, but the only thing is that a thinking is required. At least one time you have to solve this problem without seeing the solution, only then you will get the clarity. Okay, how much ever intelligent you are, this is one problem that you have to solve it on your own without seeing the answer, only then you will get confidence. Okay, trust me, just by listening to this problem alone, is other problem if you listen it is not a problem, but this problem I want you to solve it using your hands. Okay, so the fund value, and then how much is the additional funds. So using the additional funds you have calculated the NAV, and the next one, the annualized return. Using the annualized return you calculated the fund return 202.18 percentage. Using the fund return you calculated the fund value, and using the fund value you calculated the NAV as on 31/3/2023, which is nothing but 26.75. But when you will get a clarity, when you draw a table like this, only when you draw a table like this you will get clarity of how to solve the problem. Are you all with me? So question number 15 is completed. A very important problem, okay, a very important problem, and a very different problem. Okay, it is one of a kind problem, so that's the reason we have took that problem. Lot of people will find difficulty, because if this problem comes in the examination, only 50% students will be able to do this problem, unless you have already tried it. Okay, so now let us come to the next one. Okay, let us come to the next one, which is 16. So 16, you know, here portfolio theories are used. So 16 is nothing but mutual fund concept coupled with portfolio concept, because correlation coefficient is given, so you have to find out the return of the portfolio and the risk of the portfolio. Okay, return of the portfolio and the risk of the portfolio. So this is actually not a mutual fund problem, but this is a portfolio problem, but portfolio problem mixed with return, which is sharp. So let us just shift this problem. Okay, 16 we will do it afterwards. Okay, 16 we will do it afterwards. So here beta is there. Okay, so 17 ratios will do it afterwards. So let us see question number, okay, let us see question number 18. Again let us see question number 18. It is also a very good problem. Okay, it is also a very good problem. Sir, my date of investment for all the months are given. My amount of investment is given. My NAV at the entry date, so opening NAV is given. My closing NAV is given, and my dividend amount is given. Okay, suppose if dividend per unit is given, this becomes very easy. Dividend per unit is given, this becomes very easy, but instead of dividend per unit they have given dividend amount. Now just because dividend amount is given, what you have to do, you have to convert it into value. So sir, what is happening here? Amount of investment is 12 lakh and 10.25. So how many units you have purchased? So with the number of units, you have to calculate the dividend per unit, and using that you can solve it. Or what you can do, opening NAV and closing NAV also you do it in value. Okay, opening NAV and closing NAV also you do it in value, and then using the value you calculate dividend. Both will be give you the same answer only. Okay, two different methods. So let us see question number 18. After question number 15, let us see question number 18. Question number 18. Okay, sir, when you read this question number 18, always read the question first. You are required to calculate the effective yield per annum. So annualized return in respect of each of the three schemes to Mr. Rakesh up to 31/3/2023. Very important. Which means from 1/4 to 31/7, from 1/5 to 31/7, from 1/7 to 31/7. Okay. So for that, how I am writing this? First I am writing the date of investment 14/15/17. So for this I am finding how many months I have stayed invested, because to annualize return I have to do divided by period of return, correct? So what is my period of return? It alternatively can also be in days, but I am putting it in months. Okay, so April I am investing, so April, May, June, July, correct, because 31st July. So April, May, June, July, 4 months. May, June, July, 3 months, and 1st July only I have invested, 31st July, so 1 month. This much clarity you are having. So number of months of investment. Sir, what is my NAV at the beginning? 10.25, 10.15, 10 given in the question. 10.25, 10.15 and 10. Sir, how much I have invested, sir? 12 lakh, 4 lakh, 2 lakh 50,000 given in the question. Sir, now how many number of units I have purchased? Which is nothing but investment divided by NAV at the beginning. So this much number of units I have purchased, this much number of units I have purchased, and here this much number of units I have purchased. Sir, NAV at the end. Okay, this is the NAV at the end. What is the value at the end? Value at the end is nothing but this number of units has become 10.20. So 10.25 has become 10.20, which means 12 lakh has become 11 lakh 94,146. So this is what is value at the end, number of units purchased into NAV at the end. And then what is my capital appreciation or capital depreciation? How much my capital has increased or decreased? Alternatively, how you can do? 10.20 minus 10.25 multiply by number of units, which is 1,17,073. Directly you can come at capital appreciation, but I'm including in one extra step, just okay, if at all someone don't feel comfortable, you can do it in this way. Sir, which means for fund A my value has been reduced to 5854. Fund B, the value has been reduced to 39541. My fund C, the value has been reduced to 2500. Sir, what is the dividend I received? 23,000, 6,000 given in the question. Okay, dividend given in the question 23,000, 6,000. Sir, what is my total return? The capital appreciation and the dividend. This is what is my total return. So though my capital depreciated, I received 23,000. Okay, and so 17,146, 9,941, no dividend, so negative 2,500. Sir, what is my absolute return? What is absolute return? Absolute return means this 17,146 divided by the investment, which means this is the return for 4 months. Absolute return. Clarity, this is the return for 4 months. This is the return for 3 months, and this is the return for 1 month. So this is what is absolute return. Sir, which is nothing but the total return divided by the investment. So here this is the 4 month return, this is the 3 month return, and this is the 1 month return. 17,146 by 12 lakh, 9,941 by 4 lakh, and then 2,500 by 2,50,000 rupees negative. Okay, so this is negative 1%. What they have asked? They have asked annualized return. Okay, what they have asked? Annualized return, effective yield per annum basis. So annualized return. Sir, how can do annualized return? This divided by this 4 months. Okay, so 11 absolute return divided by 4 months into 12 months. This divided by 3 months into 12 months, and this divided by 1 month, so it is into 12 months. So this is minus 12% because this is 1 month return, so directly into 12 months. Clarity? So this is what is my annualized return: 4.2864 percentage, 9.94 percentage, and then 12 percentage. They only ask you are required to calculate the effective yield. That's it. Had they asked also advice, 2 marks will go if you don't write. Had they asked also advice, so which means you have to write it is advisable for this person. Okay, it is advisable for Mr. Rakesh Yadav to go and invest in mutual fund B. Okay, to go and invest in mutual fund B as it is having the highest annualized return. Okay, as it is having the highest annualized return. Are you all with me? Okay, so this much clarity you guys are having? Yes or no? Okay, so we are fully into mutual fund. Okay, currently we are fully into mutual fund. Okay, sir. Now, okay, everyone, fine. Just a moment. Super. See, we have completed how many questions? We have completed question number 14. We have completed question number 15. And then we have completed question number 18. Okay, 3 questions have been completed. Slowly we will complete all the questions and we will also pick up the speed. Okay. Now, sir, this much we have done. Okay, this much we have done. Now let us go on. Okay, let us go on to the next discussion. Okay, let us go on to the next discussion. We also have certain ratios in mutual funds, because in mutual funds we also have to do performance evaluation, correct? So for performance evaluation we have certain ratios. One is a Sharpe ratio. 3 ratios you should understand, pa. Okay, sir, Sharpe ratio, Trainer's ratio, and Jensen's alpha. Sharpe ratio means RP minus RF divided by risk of the portfolio. Okay, for example, it is nothing but the risk of the mutual fund. So return of the mutual fund minus the risk free rate divided by risk of the mutual fund. A return of the mutual fund minus risk free rate divided by beta of the mutual fund. What they are asking, pa. Okay, what they are asking. Sharpe ratio means how much return I am earning per unit of risk. Sir, first thing you should be understanding here is that what is risk? Okay, standard deviation is risk. Or before going that, okay, let us start this risk return thing. Okay, let us start this risk return thing. Okay, let us start this risk return thing. Sir, what is the risk, sir? Okay, always the sigma. Okay, this is the risk. Okay, this is the risk. Standard deviation is the risk. Sir, you are earning so much of return. See, I am not going into lot of deep concepts and all. Suppose I'm having security X and I'm having security Y. Okay, I'm having security X and security Y. Security X is giving me 10%, 10%, 10%, 10%, and then 10%. Okay, so if at all I want to see what is my average return, so average return is also 10 plus 10 plus 10, 50 divided by 5, correct? 50 divided by 5 is equal to 10%. Suppose security Y is, let us say, minus 10%, then it gave me 5%, then it gave me 15%, then it gave me 20%, and then it gave me 30%. Just a moment, wait, then it gave me 20%. So 20. Okay, so now what is my average return? My average return here is, okay, my average return here is minus 10, 5, 15, 20, 20. So the total comes to 20, 20, 40, 20, 20, 40 plus 20 60 minus 10 is 50. So average is 50 divided by 5 is 10%. Now if someone is asking you, sir, which security I should invest, sir, security X or security Y? Okay, so this is 1 2 3 4 5 year. Okay, so year 1 2 3 4 5. Sir, security X is also giving you average return of 10%. Security Y is also giving you average return of 10%. Which security you are going to invest is a question. You will tell, sir, average return is same, indifferent. No. Though the average return is same, you also have to see return. From the return aspect, it is same, but you also have to see from the risk aspect here. Okay, you also have to see from the risk aspect here. Which one you feel it is risky, pa? Logically, if you see, Y is risky. Why? Because in Y, negative return is also possible. You are investing in Y, and you are supposed to, you may also get a negative return. So that is the reason why is risky. Are you all with me? So risk is nothing but how much you are able to lose. What is the variance, correct? What is the variance? So that is what is the risk. If you see in X, there is no risk. In X, sir, how many years, sir? It is like a government bond. Every year same percentage return. So 0 is the risk. But here you will have lot of risk. Okay, here you will have lot of risk, and the risk that you have to calculate, risk is nothing but the variance from the deviation. So this is 10, right? So what is 10 minus 10? Okay, so from the mean of 10, how much it is varying? So 10 x minus x dash, so you have to do y minus y dash here. So y minus y dash is nothing but what is the variance from the mean? The variance from the mean is 10 minus of minus 10, 20. So 20 reduction is there. Okay, so 10 minus 5, 5. So here 20 less. Okay, here 5 less. 5 minus 10. Okay, so minus 10 minus 20. So my mean is 10, my average is 10. From the average I am deviating 20, so 20% less I got. So my mean is 10 and my return is 5. So from the average I am deviating 5. So here 5 negative. Okay, so here 15 minus 10 is 5. 20 minus 10 is how much? 20 minus 10 is 10. 20 minus 10 is 10. So this is nothing but the mean deviation. This is also called it as mean deviation. But if you total this, you will get 0. So what you will do? You will do mean deviation square. Okay, you will do mean deviation square. Why? Just to get what is the square of the deviation. Okay, what is the square of the deviation? So 20 into 20 is 400, 25, 25, 1000. Sorry, 20 into 20. 20 into 20 is equal to 400. 10 into 10 is 100. Okay, so 10 into 10 is 100, 100, 100. Clarity. So what is my square of the mean deviation? 400, 500, 600, 700. So what is my standard deviation? Root of 700. Are you all with me? My standard deviation is root of 700, which is nothing but 26.46%. Are you all with me? 26.46%. I hope I'm not doing any mistake. Sorry, this is the 700, right? This is the 700. This 700 is for all the years. Okay, the 700 is the for all the years. So what is my variance? My variance is not 700%. It is 700 divided by 5. So what is 700 divided by 5? 700 divided by 5 is 140. So my standard deviation is root of 140. So what is root of 140? 11.83%. This much clarity you are having. So this is what is the standard deviation, which means you are getting a formula. Sir, standard deviation, or let me call it first variance formula. Variance is equal to sigma x minus x dash. So this is nothing but sigma x minus x dash square divided by n, and standard deviation is nothing but variance ka root, so which is nothing but sigma x minus x dash square divided by n, the whole root. This much clarity you are having. Super. Slowly I will give you some notes and then we are going to solve some problems. Sir, what is the annual return from the security? The market price as at the end minus market price at the beginning plus the dividend that I received divided by market price at the beginning. Similar to what we see from the mutual fund return. Same thing, only annual return from the security. So we are coming into security analysis and portfolio management. These ratios for now you just keep a hold. First we will learn how to calculate return from portfolio, return and the sigma, and then we will come on to the ratios part. Okay. Okay, sir. Which means nothing but, this is nothing but the capital appreciation. This is nothing but the dividend divided by opening market value. This is what is the annual return from security. Sir, what is the expected return from security? Sigma x by n. Expected return from security is also called as mean, sigma x by n, or sigma x into probability. If probabilities are given, directly multiply probabilities. If no probabilities are given, assume same probabilities, so divided by n. Clarity. Sir, what is the variance formula, sir? Sigma x minus x dash by n, or here sigma x minus x dash square by n, or sigma x minus x dash square into probabilities. Sir, what is the standard deviation? Nothing, variance ka root. Sigma x minus x dash square divided by n the whole root, sigma x minus x dash the whole square into p the whole root. This is what is the standard deviation of the security. This much clarity you are having. If you are having this much clarity, okay, if you are having this much clarity, we are going to see question number 19. Calculate expected return and variance. Okay, calculate expected return and variance. Question number 19. Okay, question number 19. Sir, question number 19. How to solve this problem, sir? First, see year 0, year 1, year 2, year 3, year 4, year 5. Dividend is given, market price is given. So where is opening market price and closing market price? See, year 0 is the opening market price. Year, this is the closing market price. Okay, this is nothing but the closing market price. So for year 1, 20 is the closing market price and 30 is the opening market price. For year 2, 28 is the closing market price, 20 is the opening market price. This much clarity you are having. So which means, what is my year 1 return, sir? What is my year 1 return? My year 1 return is, first, what is the capital appreciation? 30 is becoming 20, so which means there is a reduction. Correct. So closing minus opening. 20 minus 30. Okay, 20 minus 30. Plus what is the dividend I received? Plus 1.75 divided by my opening market price, which is nothing but 30. Okay, so 20 minus 30 plus 1.75 divided by 30 into 100 is negative 27.5 percentage. This is my year 1 return. Similarly, do for year 2, year 3, year 4 and year 5. Sir, how we have solved this problem? First I have put years. Then I have put the closing market price. These both are given in the question, directly from the question, years. Because I want from 1, 2, 3, 4, 5, okay, not from 0. So dividend and then opening market price. Okay, dividend and then opening market, closing market price. Then from the closing market price, I will arrive at the opening market price. For year 1, opening market price is given 30. So this is 30. For year 2, what is opening? 20. For year 3, what is opening? 23. For year 4, what is opening? 42. For year 5, what is opening? 50. Sir, now I know, sir. Closing minus opening appreciation plus dividend divided by opening is the return percentage. That is how we have calculated. Minus 27.5%. How, sir? 20 minus 30 plus 1.75 divided by 30. Clarity. So likewise, what I will do, I will calculate all the return percentage. I will calculate all the return percentage, which is nothing but 183.44 percentage is the return for all the 5 years. So what is my average return? 183.544 is the total of this 5 years. So average is nothing but divided by 5, assuming equal probability. So divided by 5. So my expected return is equal to 36.69 percentage. Clarity. So my expected return is 36.69 percentage. So this is nothing but the average of this return. 36.69 percentage is my expected return. Okay. Sir, what is my standard deviation of the return? Similar calculations we have already made. Okay, I will do one more problem for standard deviation of returns also. This much clarity you are having? Super. Sir, let us go to question number 20. Sir, expected return we have calculated. Variance, keep a hold. Okay, just keep a hold. Let us go to question number 20. Similar question, same question only. Okay. Forecast return of securities A and B are laid out below. Security A and security B. This was directly, this is probabilities. Okay, this is probabilities. Sir, this is my return. Directly they have given return. Otherwise, they could have given dividend market price, and then we have to find out the return. From return, we have to find out expected cash flow. Sorry, expected return. But here directly they have given return, and then directly they have given the return. This much clarity for security A and security B. First requirement, find out the expected rate of return of each securities. How to find out the expected rate of return? Return into the probability. I've already told you sigma x into p. Clarity. So this is what is the expected. Sir, how to solve? Security A. Sir, what is my probabilities of A? What is my return of A? And what is my expected return? So this is what is my expected return, which is 25%. Sir, here don't do divide by 5 and all pa, because you have multiplied probabilities, understanding, right? So 25% is the expected return. This much clarity you are having. So if it is probabilities, then it is 25%. Similarly for B, it is all the probabilities you write, all the returns you write, multiply probability into return, you will get the expected return. And what is my expected return? 26%. Okay, so 25% and 26% is the expected return. This much clarity you are having. So this is done. Sir, find out the standard deviation of each security, sir. What is the formula for standard deviation? First mean deviation. Okay, first mean deviation. So A minus A dash, which is nothing but 15 minus 25 minus 10. 25 minus 25 minus 5. 25 minus 25 0. 30 minus 25 it is 5. 35 minus 25 it is 10. Sir, mean deviation. Second what, sir? Mean deviation square and to calculate variance into probability. So directly the two steps I am doing it one step. So A minus A dash square into probability. So what is minus 10 into minus 10? Positive 100 into 5% is 5. Sir, 5 into 5 25 into 20% is 5. Sir, 0 na 0. Correct. 0 multiplied by anything is 0. Sir, 5 into 5 25. 25 into 20% is again 5. Sir, 10 into 10 is 100. 100 into 5% is again 5. Clarity. So what is my variance? My variance is 20. If my variance is 20, what is my standard deviation? Root of 24.47%. Clarity. Standard deviation, it will be in percentage. Okay, or variance will not be in percentage. Variance is a number. Variance is a number which is actually percentage square. Okay, so this is what is my standard deviation. I am not going very depth, assuming that you all know. The purpose is to solve the questions and to know what are the different types of questions are possible. Similarly, I have to do for B. Sir, expected return 26. So 8 minus 26 negative 18. 18 minus 26 negative 8. 26 minus 26 0. 34 minus 26 8. 44 minus 26 is 18. Clarity. Now B into B. Okay, so which is nothing but the whole square into probability. So 18 into 18 into 5% is 16.2. 8 into 8 64. 64 into 25% is 16. So 0 na it is 0, again 16 and 16.2. So what is my variance? My variance is 64.40. If my variance is 64.40, what is my standard deviation? My standard deviation is 8.02%. My only request is that, okay, before the examination, see this question and few questions you always solve it, because a lot of blunders and calculation mistakes are possible here. So now, sir, my expected return for A is 25%. My expected return for B is 26%. If the question asks which security I should invest with respect to return, then you will say B. B is having high return. Which security I have to select with respect to risk, then what you have to do? You have to write the standard deviation. Here it is 4.47, here it is 5.02. So risk is lesser here. So if the question is asked, find out the, or they will ask which security to invest with respect to return, then the answer should be B. Suppose the question is which security to invest with respect to risk, then your answer should be A, because it is having a lower risk. So high risk, high return, low risk, low return. Clarity? Appa sir, what I should select, sir? If they are asking, find out which security to select, which respect to both risk and return, then you have to calculate something called as coefficient of variation, which is nothing but expected return divided by standard deviation. Covariation, expected return divided by x dash divided by standard deviation of x. Okay, x dash divided by standard deviation of x. Sir, what is the meaning, sir? What is the return per unit of risk? Okay, what is the return per unit of risk? So this is nothing but the return. So A you see 5.59 and B you see 3.24. So please go and invest in B. This is what is the answer. Okay, please go and invest in B, because B is giving you more return with respect to per unit of risk. So this is giving you 3.24 per percentage of risk, and this is giving you 5.59 per percentage of risk. So it means this 5.59 is better. So coefficient of variation you have to find out. Though it has been not asked, suppose the exam says, okay, suppose the examiner says based on return B, based on risk A, based on both return and risk, or based on coefficient of variation again A. So this is how you have to answer. Okay, this is how you have to answer the question. Clarity? So expected return, expected rate of return is completed. Standard deviation of each security is completed. Comment with reason as to which of the two securities has more upside potential and downside risk. So more upside potential Y, more downside risk X. Are you all with me? So there is a more downside risk. Clarity? Now, independent of the first three elements, assume now that the probability of return for security B will be identical of that A. Now, because the probability for security B is different than A, right? Assume that this probability is there for B. So same probability. Okay. Then compute the expected return. Okay. Then compute what is expected return. So which means now you have to find out the expected return again. Okay. You have to find out the expected return again. Security B, but with the probability of A. Sir, why they are asking this, sir? Because the next question is we have to find out what is the expected return of the portfolio. Security X separately you found out return and risk. Security B expected differently you found out. Okay, what is the return and risk? Now they are asking what is the return or risk of the portfolio. Sir, what is the portfolio, sir? Combination of different securities. Portfolio means combination of different securities. So two combination of different securities. Okay, one security is giving you 10% return, one more security is giving you 20% of return. So what is my total return? 30% are wrong. Because if someone is asking, now weight also comes into picture. Sir, 10% but 50% invested, 20% but again one more 50% invested, which means my expected return is 10 into 55% plus 10%, it is coming to 15%. This much clarity having, this is what is the expected return of the portfolio. So for that you have to find out security B. Okay, so again security B for probability of A. So this is the probability of A, the return of B, the expected return of B 26, then the mean deviation and the variance. So variance and standard deviation 7.62%. Again you have to calculate this. This much clarity if you guys are having, let us jump on to the next one. Okay, every formula is a question. This formula is a question. Okay, this formula is a question, variance and standard deviation. Okay, every formula is a question. Now, sir, what is the expected return of the portfolio, sir? Weight of A into return of A plus weight of B into return of B. Sir, what is the variance of the portfolio, sir? See, variance is nothing but square. Correct? Variance is nothing but square. So it is nothing but this square, but not return risk. Okay, not return risk. So what is a square? Understanding? Hello? Are you guys understanding? So it is nothing but square. Weight of A into standard deviation of A plus weight of B into standard deviation of B square. Correct? Because that is what is the variance. Now whenever it is square, the formula is weight of A square into standard deviation of A square plus weight of B square into standard deviation of B square plus 2 into weight of A into standard deviation of A into weight of B into standard deviation of B. But here you have to multiply something called as correlation coefficient of A and B. Why, sir? But whenever we are investing in more than two securities, security A and security B, whenever we are investing in more than two securities, one factor that will affect is weight of what is the security. Another factor that will affect is what is the risk of the security. Third factor, how these two security moves together. That is what is the third factor, which means what is the correlation. Is the correlation positive, which means if A is moving forward, B is also moving forward. If A is coming down, B is also coming down. Correct. So that likewise, so if both are increasing, it is positively correlated. If both are decreasing, it is again positively correlated, because moves in the same direction. One is increasing, one is decreasing, it means it is negatively correlated. Are you all with me? So whenever you see, whenever you are putting in a portfolio, you have to build a diversified portfolio. Okay, you have to build a diversified portfolio to reduce the risk. So here I have to multiply, because both the weights are combined, right? So which means I have to multiply into R into AB. Clarity. So this is what is the formula. This is what is the formula. Weight of A square into a standard deviation of A square plus weight of B square into standard deviation of B square plus 2 into small mistake, okay, small mistake, plus 2 into okay, weight of A plus 2 into weight of A into standard deviation of A into weight of B into standard deviation of B into R of AB, okay, into R of AB. So this is what is the formula, okay, this is what is the formula for variance. Sir, if this is the variance, what is the formula for standard deviation? Nothing but, okay, well, standard deviation is the square root of this, the square root of this. So weight of A square plus standard deviation of A square plus weight of B square plus, into standard deviation of B square plus 2 into weight A into standard deviation A into weight B into standard deviation B into R into AB, okay, into R into AB. This much clarity you are having. Now, sir, what is correlation coefficient, sir? RAB means what, sir? What is the correlation coefficient? It is nothing but correlation between security A and B. How to calculate, sir? Correlation coefficient is equal to covariance of A and B divided by standard deviation of A into standard deviation of B. Suppose, sir, to find out correlation coefficient, I should know what is the covariance. Sir, what is the covariance of the security, sir? The mean deviation of A multiplied by mean deviation of B sigma divided by n. So it is nothing but how both of the securities are moving together. So mean deviation of A multiplied by mean deviation of B divided by n. Okay, well, so this is what is the formula for covariance. Clarity, sir. I am just writing, okay, not going much very much deep. Otherwise, this explanation itself will go for 6 to 8 hours. Sir, weight of A square into risk of A square plus weight of B square into risk of B square plus 2 into weight A into risk of A into weight B into risk of B into R of AB. Okay, ba? This is what is the variance formula. This is what is the variance formula. Sir, what is R of AB? Correlation coefficient is nothing but covariance of AB into, okay, covariance of AB into, sorry, divided by risk of A into risk of B. So which means if at all I plug in this RAB, so this formula, if I plug in here, what will happen? This and this will be cancelled, correct? And instead of this, what I will write? So which means what will happen? Weight of A square into this square plus weight of B square into risk of B square plus 2 into weight of A into this into weight of B into standard deviation of B multiplied by, instead of RAB I will write covariance of AB divided by standard deviation of A and standard deviation of B. So standard deviation of A and B is cancelled. So I can also write weight of A square standard deviation of A square plus weight of B square and variance of B, or standard deviation of B square, plus 2 into weight A into weight B into covariance of AB. This is also one more formula. So that's the reason I put OR. Okay, that's the reason I put OR. I can also put it as 2 into weight A, weight B, covariance of AB, or 2 into weight A standard deviation of A, weight B standard deviation of B, and correlation coefficient between A and B. Okay, both will be same only. If covariance is given, write this formula. If correlation coefficient is given, write this formula. Clarity? Okay, logic and all can be explained in the regular class. Okay, I am expecting that in the next few hours this entire chapter should be completed. It's a big chapter, lot of problems, but entire chapter we will complete it. This much clarity up, sir. If someone is asking what is the risk of the portfolio, this is what is the risk of the portfolio, standard deviation. If someone is asking what is the expected return of the portfolio, this is what is the expected return of the portfolio. Are you all with me? So variance of the portfolio, what is the covariance, and what is the covariance between security A and B. So here what they are asking the expected return from the portfolio if it is formed with 70% in A and remainder in B. So weight of A is equal to 0.7 and weight of B is equal to 0.3. Weight is given. Clarity, weight is given. What they are asking, expected return from the portfolio. Okay, sir, clarity. Sir, what is the expected return of the portfolio? Weight of A is 70, weight of B is 30. What is the expected return formula, sir? Weight of A into return of A plus weight of B into return of B. What is weight of A? 0.7. What is return of A? 25% and return of B is 26%. Are you all with me? So 0.7 into 25% plus 0.3 into 26%. My expected return from the portfolio is 25.3%. Clarity. Sir, what is the standard deviation of the portfolio? The formula, weight of A square into this square, weight of B square into variance of B, 2 into weight of A into weight of B into covariance of AB. Okay, into covariance of AB. Okay, into covariance of AB. Now let us see, is covariance of AB is given in the question? Covariance is not given. Appo nothing is given, but security A and security B is given, right? So we can find out the covariance. Okay, we can find out the covariance, and they have also asked us to find out covariance and correlation coefficient. This is also we have to find out. Okay, so anyhow we will want to know the covariance. Okay, we will want to know the covariance. Sir, how to find out covariance, sir? Covariance of AB is nothing but mean deviation of A. This is nothing. Okay, mean deviation of A, 10, 5, 0, 5, 10, right? Mean deviation of A, 10, 5, 0, 5, 10. Mean deviation of B, 18, 8, 8, 18, 18, 8, 18. Mean deviation of A into mean deviation of B into probability. Clarity. So minus 10 into minus 18, which is 180 into 5%, 9. So this is what is covariance of AB, which is nothing but 34. Sir, what is correlation coefficient, sir? Covariance of AB divided by standard deviation of A into standard deviation of B. So 34 divided by 4.47 into 7.62, which is equal to 0.9982, which is equal to 1. So which means the securities are perfect positive correlated. If my R is equal to 1, it is called as perfect positive correlation. Okay, so which means what, sir? If A is increasing, B is also increasing. If A is decreasing, B is also decreasing. You see A and B, you see the return. Okay, you see the return of A and return of B. Return of A 5 and 20. So which means second year it has increased 15 and 20. You see this has also increased 8 and 18. 20 and 25. 20 and 25. So 18 is becoming 26. Clarity. So this is what is the correlation coefficient. Suppose one is increasing and one is decreasing, it will be negative. Clarity, you are having clarity. Okay, if both are moving in the same direction, your correlation will be positive. If both are moving in the opposite direction, the correlation will be negative. Okay, so this is what is correlation coefficient. Sir, my correlation coefficient is 1 and my covariance is 34. So the answer is my covariance is 34 and my correlation coefficient is 1, and my return from the portfolio is done. Now what is my risk of the portfolio? Okay, what is my risk of the portfolio? Sir, you already know the risk of the portfolio formula. because now you know the covariance. So 0.7 square into 4.47 square. What is 4.47, sir? Standard deviation of A. Okay, standard deviation of A, 4.47. Sir, what is my standard deviation of B? 7.62 square. So 4.47 square and 7.62 square. Okay, 7.62 square. 0.7 square into this, 0.3 square into this, plus 2 into 0.7 into 0.3 into this, 34. Sir, calculated trick I will show you. One calculated trick. How to do this? Okay, well, how to do this? Do 0.7 into 0.7 into 4.47 into 4.47 equal to, keep this in m plus. Okay, and then clear. Then 0.3 into 0.3 into 7.62 into 7.62. Okay, second term, keep this in m plus. 2 into 0.7 into 0.3 into 34. One more, keep in m plus and do MRC. You will get 29.296. This 29.296, you just do the root, you will get 5.41 percentage. Okay, small calculated trick. So this m plus, if you do in m plus, any big number, even if it is 3 securities, that big number can be calculated using one calculation. You don't have to calculate it again and again. People think that it is time consuming, but if you are using some calculated tricks, things becomes very easy. Are you all with me? So this is what is the standard deviation of portfolio. So with this, we have completed question number 20 and we have also completed question number 19. Appa sir, if you know how to calculate the variance, you can also calculate the variance here. So question number 19. Question number 19. Question number 19. The standard deviation is your homework. Okay, ba? Your standard deviation is your homework. So you have to find out the standard deviation of this return. Are you all with me? Calculate the standard deviation and put it in the comment section. This, okay, for this return you have to calculate the standard deviation because your expected return is 36.69 percentage. So x minus x dash, which is 33.669, and then the total is the variance, sorry, divided by 4 is the variance, and square root of that is the standard deviation. Clarity? Okay, sir. So 19 is completed and then 20 is completed. Okay, 19 is completed and 20 is completed. Are you all with me? Now, okay, 20 is a very good problem. Now let us jump on to question number 21. Sir, how to calculate beta, sir? Okay, how to calculate beta? Let us jump on to the note, sir. Till now we all are okay, sir. Till now we all are okay. Sir, what if someone is asking, what is the risk of portfolio A, B and C? If it is A, B and C, formula becomes very big. So, weight A square sigma A square plus weight B square sigma B square plus weight C square sigma C square plus 2 into weight A into weight B, sorry, 2 into weight A into standard deviation of A into weight B into standard deviation B into correlation coefficient of AB, 2 into weight of B into standard deviation of B into weight of C into standard deviation of C into correlation coefficient between B and C, 2 into weight of A into standard deviation of A into weight of C into standard deviation of C into correlation coefficient between A and C. See, do not worry, this is nothing but A plus B plus C the whole square formula. A square plus B square plus C square plus 2AB plus 2BC plus 2AC. Clarity? Now wherever AB, BC and AC are there, correlation between AB, correlation between BC and correlation between AC is there. What is A, sir? Weight A into standard deviation A, square square. What is B? Weight B into standard deviation of B, square square. What is C? Weight C into standard deviation of C, square square. What is 2 into AB? So 2 into A, okay, weight A into standard deviation of A and then weight of B into standard deviation of B plus what is 2 into B into C, likewise you have to solve, okay, but likewise. So don't fear, this becomes very easy, okay, this is very easy. So wherever correlation is there, instead of that you can also write covariance, removing the standard deviation of A and B, okay. So this is what is the formula. If at all they are asking what is the standard deviation for a portfolio of 3 securities. Okay, maximum they can ask 3 securities. Don't worry, they will not ask 4 securities and all. Okay, 4 securities and all they will not ask. Otherwise, you have to do A plus B plus C plus D the whole square. Okay, so not possible practically in the examination. Practically possible, in the examination not possible. Sir, correlation coefficient should be in the range of -1 to 1. If my correlation coefficient is -1, it means there is a perfect negative correlation. Perfect negative correlation. If this is increasing by 10%, this will decrease by 10%. Okay, clarity. Sir, my correlation coefficient is -1 but less than 0. So it means it is negative. So it is called as negative correlation. Sir, it is 0, no correlation. No correlation is one is increasing or decreasing, one does not change at all. No correlation. Okay, there is no correlation. Sir, it is positive, more than 0 but less than 1. Positive correlation. Sir, it is equal to 1. Perfect positive correlation. If this is increasing by 10%, this will also increase by 10%. If this is decreasing by 10%, the other security will also decrease by 10%. So that is what is called as perfect positive correlation. So sometimes they will, based on the correlation coefficient, they can ask, okay, MCQ problems. So MCQ problems could be asked. Sir, next one, how to calculate beta, sir? What is the meaning of beta? First one, beta is nothing but the sensitivity of the security with respect to market. How my security is moving with market. So for that you should know what is the correlation between your security and market. So R of XM is very important. So what is the beta of the security, sir? R of XM into risk of security X divided by risk of market. Clarity. So R of XM into risk of security divided by risk of the market, that is what is the beta of the security. This much clarity you are having. Okay, I am not discussing any logic, I am telling it again and again. You can find many videos where logics have been discussed, even I can discuss the logic, but in an interest of time and with an assumption that you already know the formulas, we are just brushing the concepts and doing the problems. Problems are given more importance at this point in time. Sir, what is the formula for beta, sir? The formula for beta is R of X and M, correlation between the security and the market. Okay, correlation between the securities of the market into the risk of the security divided by the risk of the market. Okay, into the risk of the security into the risk of the market. This much clarity you are having. Super. Sir, instead of R, can I write coefficient of correlation? Okay, you can also write covariance of X and M. Appo R of X and M is nothing but covariance of X and M into this and this. This is what is R of X and M into this divided by standard deviation of the market. So my other formula is covariance of X and M divided by variance of the market. Okay, covariance of X and M divided by variance of the market. Okay, so you have two formulas for beta. Both the formulas are derived from each other only. Okay, there is no two different formulas. One formula, if you remember, other formula you can very easily find out. Sir, what is the formula for beta, sir? The formula for beta is R of, so correlation between X and M multiplied by standard deviation of security divided by standard deviation of the market. It is also called a sensitivity of security with respect to market. Or else the second formula is covariance between the security and the market divided by the variance of the market. Clarity. If at all the question tells the variance of market is equal to 55, okay, and beta is this, calculate the covariance or calculate the correlation coefficient. So you can find out, okay, these things at all. Sir, beta of the security, you know, sir. What if I am having a portfolio? What is the beta of the portfolio? Beta of the portfolio is nothing. Okay, beta of the portfolio is nothing but the correlation between the portfolio and the market multiplied by risk of the portfolio divided by the risk of the market. Same formula only, but instead of x I am putting p. Clarity, instead of x I am putting p. Because how to calculate return of portfolio you already know. How to calculate risk of portfolio you already know, but standard deviation of portfolio. So that standard deviation of portfolio divided by standard deviation of the market. Okay, standard deviation of the market will always be given in the question. Okay, or covariance of portfolio and the market divided by this. Or the second thing is that beta of the portfolio is nothing but weighted average. If you know the beta of two securities, suppose your portfolio is having only two securities, it is nothing but weighted average beta. If more than two securities, then it is nothing but the weighted average. Clarity, if more securities, portfolio beta is at average of portfolio beta. This much clarity you are having. So what is the beta of the portfolio? Two formulas. Correlation between the portfolio and the market multiplied by standard deviation of the portfolio divided by standard deviation of the market, or weighted average beta. Sir, what is weighted average beta? Weight of A into beta of A plus weight of B into beta of B. Are you all with me? This much clarity if you guys are having. Sir, where beta can be used, sir, in the examination? In the examination, if the question is asked like that, if my market is falling by 10%, how much my security is falling? So which means this answered by beta. First you calculate the beta. Suppose if beta is 2 times, if the market is falling by 10%, your security will fall by 20%, like leverage. Clarity. Okay, suppose your beta is 2 times and your market is falling by 10%, your security will fall by 20% because the beta of the security is 2 times. Clarity. So this is how the questions will be answered, and the same concepts can be used in mutual fund also, because mutual fund end of the day is nothing but a portfolio of securities. Question number 21. Calculate the portfolio beta. It is nothing but find out the weight and then multiply it by beta to find out the portfolio beta. Clarity. So question number 21. Sir, question number 21. How to calculate the portfolio beta? Security A, B, C, D, number of shares, market price, find out the value. Using the value, find out the weight. You know the weight, you know the beta, multiply, you will get weighted beta, add, you will get the portfolio beta. Small mistake, this is not standard deviation, this is portfolio beta. Clarity, this is portfolio beta. So my portfolio beta is 1.129. Are you having this clarity? 1.129. See, I am not doing much efforts in the calculation because all are calculated tricks. You should know how to solve. So here weight was the only thing. Okay, so with number of shares and market price, if you multiply, you will get value. With value, you will get the weight. Upon weight into the individual beta, you will get the weighted beta, which is nothing but the portfolio beta. Clarity. Next one. What is telling? If the portfolio manager seeks to reduce the beta to 0.8, currently my market is my portfolio is 1.129 times sensitive to the market, which means if my market is increasing by 1%, my portfolio will increase by 1.129%. If my market is falling by 1%, my portfolio will fall by 1.129%. This is what is the meaning of beta. Now what he is telling, I don't want too much sensitivity and all. I want 0.8 sensitivity. So which means I want my portfolio beta to be reduced to 0.8. So how it will reduce? How much risk-free investment should you bring in? Sir, what is risk-free investment? Risk-free investment is some government bond. Usually in government bond beta will be 0. Risk-free investment means beta is 0. Clarity, risk-free investment means beta is 0. So some investment you have to bring in where the beta is 0. How much you have to bring in to reduce your beta to 0.8? Now see, very interesting question, very interesting question. Just see pa, just see now. Okay, just see now. Currently you have invested 13 lakhs. Just see this question. A lot of people will make a mistake. Currently you have invested 13 lakhs. And this 13 lakhs comprises of 100% of other 4 securities. The other 4 securities remain the same. you have to add something more that will have some weightage, but that will have a beta of 0. So this will be 0, but you want your portfolio beta to be 0.8. Clarity. So this weight will change, but this will not change. Are you all with me? Clarity. So your 1.129 should become 0.8. Your 1.129 should become 0.8. So 0.8 should be the weight of the the weighted beta of the other securities. Clarity. So which means what? How much risk free to be added to reduce the portfolio beta to 0? Beta of risk free is 0. What is the weighted beta of other asset? 0.8. Because currently it is 1.129, but you want to bring this total to 0.8. Correct? So weighted beta of other assets is 0.8. Sir, in 100% investment, my beta is 1.129. For 0.8 beta, how much percentage investment should be there? Okay, for 100% weight, my beta is 1.29. For 0.8 beta, okay, 0.8 beta, how much should be my weightage? This is what I'm calculating. So I'm getting that my weight of the other asset should be 70.86%. This much clarity you are having? Sir, it should be 70.86%. Are you all with me? Sir, which means my weight of the risk-free asset should be 29.14%. My weight of the other asset should be 70.86%. My weight of the risk-free asset should be 29.14%. Now I want to find out my value of the risk-free asset. Sir, how will I find out? This 13 lakh investment value is for 70.86%. So for 29.14, how much? So this comes to 5,34,603. Cross multiplication pa. 1 mango 10 rupees, 2 mangoes how much? Same calculation only we are doing. This much clarity you guys are having? Okay. So what is my value? 5,34,603. You just check this revised portfolio. 12,000 all the values you put. 5,34,603 also you put the weight, you put the beta, you will get 0.8. Okay, you will get 0.8. This is just a check that you have to do. Okay, and you have to show it in the examination also that your revised beta is coming to 0.8 if this is your investment pattern. Okay, if this is your investment pattern and this is the risk free asset, which means 1.14, by injecting some risk free asset, you're reducing your portfolio beta to 0.8. Why? Because when you're injecting, you're reducing the risk. So reducing the risk means reducing the sensitivity. This much clarity you guys are having. So which means if I'm investing 5,34,603 of risk free asset, my beta will come down to 0.8. Sir, how I have calculated? Can you come again? Yes. If 1.129 beta is 100% of other assets, now I want my beta of 0.8. So what is the percentage of other assets? So 70.86% now it should comprise, because my beta here is 0. So this is 0. Clarity. So 70.86%. Or what you can do, you can find out the value. 13 lakh is for 78.16%. For 100% is how much? So 13 lakh divided by 70.86%. So 13 lakh divided by 17.86%, it is 72 lakh 70. 13 lakh divided by 70.86% is 18 lakh 34,603. This is what is the value. In study material, this is solved in this way. If 70.86 is this, total value is how much? Total value is 18 lakh. If 18 lakh is this, then how much is that? Okay, then 18 lakh minus 13 lakh is equal to 5,34,000. That is how you have calculated, or directly you can calculate like this. Okay, both the ways are same. I hope you guys are getting the clarity. Very only good problems only I have taken. Okay, so if you are feeling little bit difficulty in the problem, don't worry, I have taken only difficult problems, because these are only asked in the examination. Are you all with me? Okay, so portfolio beta we have calculated, and what is the revised portfolio? Clarity. Now, sir, question number 22. Question number 22. An investor estimates return of share in 2 different companies under 4 different scenarios. Scenario 1, 2, 3, 4. So what is the probability? So probability is given. Probability is given. What is the return of security A and what is the return of security B? Calculate the expected rate of return in security A and security B. So expected rate of return 12 into 0.2, 16 into 0.4, 18 into 0.3, 25 into 0.1. Just do the total, you will get the A dash. So this is what is the expected return. And then calculate B dash, expected return of security B. Determine preferred security based on return. So wherever your that mean is higher, that is what is the answer. Ascertain the risk associated with the security. Risk means standard deviation. So now you do A minus A dash and then A minus A dash square into probability. Okay, into probability and then whole root. You will get the standard deviation. If the investor invests 40% in A and 60% in B, what is the return and risk? So return of the portfolio and risk of the portfolio. It is similar to question that we have solved before. It is similar to question number 20. Okay, it is similar to question number 20. So that is the reason I am giving you this as homework. Why I am giving you this as homework? Because it is a very important problem that is asked multiple times in the examination. Guaranteed it will be asked here also. So solution 22. It is similar. I am not solving, I am just giving you the answer. You just take a snap of this answer, solve this and check if the answers are correct or not. What is the expected return? 16.7 and 20.5. What is the standard deviation? 3.465 and 6.130. Second question was what is the answer with respect to return? So with respect to return, B is the answer. So security B is the answer. Okay. Fourth one, they were asking what is the risk of what is the return of the portfolio? Return of the portfolio is 18.98%, which is nothing but weight of A into return of A plus weight of B into return of B. And what is the risk of the portfolio? For risk, you should be knowing what is the covariance, and using the covariance you have to find out the risk, which is nothing but 4.975, which is nothing but weight of O square into variance of A plus weight of B square into variance of B plus 2 into weight A into standard deviation of A into weight B into standard deviation of B into R of AB, or you can also put it as covariance of AB removing standard deviation of A and B. So 2 into weight A into weight B into covariance of AB. Your covariance of AB is 19.65. Weight A and weight B you know. So with that you have to find out the risk of the portfolio. Clarity, this is what is question number 22. Pause the video, solve this. Okay, online students, pause the video, okay, and solve this question. Very important, your hand should know how to solve these problems. Clarity, question number 22. It is similar to question number 20, so I am not repeating it again. Okay. Okay. Sir. Sir, which means question number 22 is done. 21 is done. Okay. Let us jump on to question number 16. Sir, Sharpe ratio. Everyone. Sir, now you know how to calculate return of the portfolio, how to calculate the risk of the portfolio. Okay, how to calculate return of the portfolio, how to calculate risk of the portfolio. A CAPM return you already know. What is CAPM return? CAPM return is nothing but the risk-free rate plus beta into RM minus RF. This is what is the expected return. Okay, or it is also called as CAPM return. Are you all with me? Or if you don't know, let me again write it down here. Expected return is risk-free rate plus beta into RM minus RF. Clarity. Sir, Sharpe ratio and trainer ratio. See how to remember. Sharpe is nothing but reward to risk ratio. How much reward I am getting for 1 unit of risk? Similar to coefficient of variation, but here we are using incremental return. You are not directly taking the return, you are taking the incremental return here. So which means what is the extra income? Extra return. Sir, if I am getting 10% and my risk-free rate is 5%, 5% extra I am getting. That extra I am getting to how much unit of risk. That is what is Sharpe ratio. Okay, that is what is Sharpe ratio. It is similar to coefficient of variation only. Clarity. So it is called as reward to risk ratio. Sir, what is trainer ratio? Reward to volatility ratio. Sir, what is my reward? To beta of the portfolio, reward to volatility ratio. Remember this part. Reward to risk ratio, reward to volatility ratio. MCQ question. Sharpe ratio, RP minus RF. Return of portfolio minus risk-free rate divided by the standard deviation of the portfolio. So trainer's ratio, return from the portfolio minus risk-free rate divided by beta of the portfolio. Clarity. This much clarity you guys are having. Super. Sir, what is Jensen's alpha? Extra return. What is the extra return that I'm getting? Actual return minus expected return. Whatever was my expectation, sir, my expectation was 15%. I got 20%, which means 5% is my alpha. So this is called as Jensen's alpha. Okay. And one more, in some questions, if Sharpe ratio and trainer's ratio itself are given, it means beta can be calculated. Sir, this total risk is there, right? It is bifurcated into systematic risk and unsystematic risk. Systematic risk is nothing but beta into standard deviation of market. Okay, not standard deviation of the security. If at all I am having total risk, okay, total risk, it means the systematic risk is beta into standard deviation of the market. It will be common for all. Okay, it will be common. And unsystematic risk is the standard error. Okay, it is the standard error. Now, I mean standard deviation of standard error. Okay. Now, sir, let us directly jump on to the next question. So, again, let us directly jump on to the next question, which is question number 16. Sir, question number 16. Mirinal fund has a fund named F3 fund. It is a fund of fund. Mutual fund itself is investing in 3 funds, which invest in 3 different funds. Okay. Fund A, fund B, and fund C. So value invested, with value you can find out the weight. Okay, you can find out the weight. Weight you know, return you know. So return from the portfolio you can calculate. Weight you know. Okay, weight you know. Standard deviation you know. If you know the covariance or correlation, the standard deviation also you can calculate. Sir, correlation coefficient is given, which means you can calculate this and you can calculate this. These two are very simple. These two are very simple. Can we quickly do again? Same thing only. Okay. 16. Question number 16. Sir, what is the formula for Sharpe index? Actually, the requirement is what? Correlation. It is risk-free return. Blah blah blah. Ascertain the Sharpe index. Ascertain the Sharpe index. Sir, for Sharpe index, what is the formula? Return from the portfolio minus risk-free rate divided by risk of the portfolio. Now we have to calculate this and this. Sir, calculation of return from the portfolio. Fund, value, weight, return, weighted return. This is what is the return from the portfolio. Simple calculation. Sir, 3 securities. Okay, here it is 3 securities. Now, sir, to 3 securities, how to find out the risk of the portfolio? Sir, 3 securities, risk of the portfolio. Sir, weight of A square into standard deviation of A square, weight of B square into standard deviation of B square, weight of C square into standard deviation of C square, plus 2 into weight of A into weight of standard deviation of A into weight of B into standard deviation of B into correlation coefficient of AB. Similarly for BC, similarly for AC. Clarity. Put all the numbers because you are having all the numbers. 0.25 square into 0.32 square into weight of A square into variance of A, weight of B square into variance of B, weight of C square into variance of C. Clarity. Then 2 into A into B. Okay, 2 into A into B. 2 into weight of A into standard deviation of A, weight of B into standard deviation of B into correlation coefficient of A and B. So correlation coefficient is 0.30, A and B. Okay, A and B is 0.30. Then B and C is 0.2. So B and C is 0.2. And then A and C is 0.50. So A and C is 0.50. Clarity. Now this again calculator trick. Don't, okay. So much numbers are there. You all will be scared. No need to be scared. Okay, take your calculator. See, within 30 seconds I can calculate. 0.25 into 0.25 into 3.2 into 3.2. First term. So this is the first term. Always see term by term. Okay, this is the first term. M plus. 0.6 into 0.6 into 4.5 into 4.5, second term m plus. Okay, now 0.15 into 0.15 into 1.5 into 1.5, third term. 2 into 0.25 into 0.6 into 3.2 into 4.5 into 0.3 m plus. 2 into 0.6 into 0.15 into 4.5 into 1.5 into 0.2 m plus. 2 into 0.25 into 0.15 into 3.2 into 1.5 into 0.5 m plus. Now if you do MRC, you will get 9.699625. Clarity? Directly, okay, no need to do it again and again, right and right. Okay, directly you do it. Okay, directly you do it. In one time you will get the answer. Are you all with me? So small calculator tricks will save your time. Okay, this is a 3 security portfolio. First time we are solving, right? Okay, 3 security portfolio. Okay, so what is my portfolio? 3.11 percentage. Clarity? Now what they are asking, ascertain Sharpe index and evaluate its performance. So Sharpe index for the fund. So Sharpe index of the portfolio and then evaluate its performance. Evaluated performance will come afterwards. First let us find out the Sharpe index. Sir, what is the Sharpe index of the portfolio? RP minus RF divided by standard deviation of P. Sir, 17.315 percentage. Correct? You calculated 17.315 percentage minus risk-free rate is 5 percentage given in the question. Given in the risk-free rate is 5 percentage. Okay, risk-free rate is 5 percentage. Are you all with me? Risk-free rate is 5 percentage divided by the portfolio variance is portfolio standard deviation is 3.11, the same 3.11. So what is my Sharpe ratio? 3.96. Now how to evaluate, sir? I will also find out what is the Sharpe ratio of the market. Information is given. The market return is 17 percentage and market standard deviation is 3 percentage. So now I will find out the Sharpe ratio for the market. Sharpe ratio for the market means return from the market minus risk-free rate divided by standard deviation of the market. Sir, what is the Sharpe ratio of the market for? You see, the return per amount of risk is more in market. What is Sharpe ratio? Reward to risk. Correct. So you see, market is giving me more return for the same amount of risk. Clarity? For the same unit of risk. Here for 1 unit of risk I am getting 3.96 return. Here for 1 unit of risk I am getting 4. So which means market is outperforming the fund. That is what is the evaluation that I have to make. So using Sharpe I am evaluating now. Okay, using Sharpe I am evaluating now. So Sharpe ratio is slightly higher for the market. So market has outperformed the portfolio. So portfolio has not even outperformed the market. The market has outperformed the portfolio. This is what is question number 6. Are you all with me? Question number 6. See the standard deviation, this return and risk, 101 percentage 2 questions will come. Return and risk, 101 percentage 2 questions will come. So you have to be ready. Okay, sir. Now, okay, now, sir, 16th one is over. 16th one is over. Okay, let us come to 17th one. Okay, sir, let us come to 17th one. Let us read the question. The following particulars are furnished about 3 mutual fund scheme P, Q and R. So P, Q and R, dividend distributed, capital appreciation, opening NAV and beta. These are given. Ascertain alpha of 3 schemes and evaluate their performance if the government of India carry an interest rate of 6.84. So risk-free rate is 6.84 percentage and the Nifty has increased by 12.13 percentage. So return from the market is 12.13 percentage. Are you all with me? Now they are asking us to evaluate the performances. So I want to find out the alpha. Okay, alpha. So what is Jensen's alpha formula? Jensen's alpha formula is actual return minus, okay, actual return minus expected return. Okay, actual return minus expected return. But what is expected return, sir? Risk-free rate plus beta into RM minus RF. Okay, sir, risk-free rate is given, beta is given, RF is given. So expected return you can calculate. Sir, how to calculate actual return? You know, capital appreciation, dividend is given, opening NAV is given. Are you all with me? So using that you can calculate the return. So total return 1.75 plus 2.97 divided by 32, okay, divided by 32, that is what is the actual return. So 17th one, very simple problem, okay. Sir, what is the formula for Jensen's alpha? Actual return minus expected return. What is expected return? Risk-free rate plus RM minus RF into beta. Sir, dividend distributed dividend distributed plus capital appreciation is my total return. Total return divided by NAV is equal to actual return. Let me keep the actual return as A. Clarity. So actual return I have calculated. Now, sir, beta given in the question. Return from the market given in the question. Risk-free rate given from the question. From these three values, calculate the expected return. RF plus beta into RM minus RF. Okay. Expected return. Sir, actual return I know, expected return I know. Jensen's alpha, actual return minus expected return. 0.19 percentage, 0.34 percentage, and negative 0.5 percentage. Clarity, okay. Negative this percentage. This much clarity you guys are having, super. Now evaluation means what? Ranking. So also put the ranking. So I will evaluate means Q is first rank, okay, P is second rank, and then R is third rank. This much clarity you guys are having. So question number 17 is also completed. So we have done one problem for Jensen's alpha, we have done one problem for Sharpe ratio, we have done a problem for risk return, we have done a problem for covariance and correlation, we have done a problem for mutual fund calculation of NAV, we have done a problem for mutual fund calculation of return, mutual fund annualized return. Are you all with me? Now, a lot of questions are done. Now let us jump on to question number, few other mutual fund problems I wanted you to do, okay. Question number 23. So before that, let us jump on to question number 18. I think question number 18 we have already completed, right? Question number 18 we have already completed, which is nothing but the annualized return. Question number 19, everything is completed. Let us jump on to question number 23. Okay, question number 23. Now, see, question number 23, let us read the problem. There are two mutual funds X and Y, each having close-ended equity schemes. NAV as on 31/12/2023 of equity is 70.71. My NAV for X is 70.71. My NAV for Y is 62.5. It is consisting of 99% equity and 1% of cash, and here 96% equity and 4% of cash. So NAV la how much is invested in equity and how much I am holding cash, I know. Following is the other information. Sharpe ratio given, trainer ratio given, standard deviation given. There is no change in the portfolio during the next month. Annual average cost is 3 rupees per unit. Okay, annual average cost is 3 rupees per unit for the scheme. For calculation, consider 12 months in a year and ignore number of days for particular month. Calculate NAV after 1 month. Very important. I want to find out what is the NAV after 1 month if the market goes down by 5%. Remember what they're asking. First of all, many people don't even understand what they're asking. If the market is going down by 5%, what is my NAV? It means what? There we have to find out something called as beta. So once I know the beta, so if the market is moving by 5%, my security will move by this rate into beta. Clarity, super. Sir, now how to calculate beta, sir? I have already told you, remember, if Sharpe ratio and trainer ratio is given, beta can be calculated. Okay, so here Sharpe ratio is given and trainer ratio is given. Using these two, beta can be calculated. Super, very good. Okay, and also standard deviation is given. So using these three, beta can be calculated. Once you know the beta, you can know, okay, you can know what is the NAV reduction. But here one more twist is that only equity NAV will reduce, cash NAV will not reduce. So first what we have to do, in the NAV we have to break what is the equity NAV and what is the cash NAV. Equity NAV will reduce by beta, okay, reduce by beta times, okay, but cash NAV will not reduce, okay, cash NAV will be staying like that. So cash NAV we will just minus the expense. That is how we have to solve this problem. Okay, question number 23. Let us jump on to question number 23. Sir, what is the NAV, sir, as on 31/12/2023? 31/12/2023. And we have to find out after 1 month, which is 31st January 2023. Clarity, super. Sir, first one, my NAV is 70.71, 62.5. I will bifurcate into equity and cash. Sir, in X 99% is equity, 1% is cash. In Y 96% is equity and 4% is cash. So what is equity NAV and what is cash NAV I will calculate. Step number 1. Clarity, super. Now next I will calculate the beta. How you will calculate the beta? Sir, Sharpe ratio is what, sir? Sharpe ratio is the return from X minus risk-free rate divided by the standard deviation of X. Standard deviation is given. So standard deviation is given means Rx minus Rf is equal to 22.5. Correct? Rx minus Rf is equal to 22.5. So trainer's ratio Rx minus Rf by beta x is equal to 15. I know Rx minus Rf. So just put this value 22.5 divided by 15. You will get the beta as 1.5 times. Clarity. Two equations, two unknown values. Correct? So two equations, two unknown values, you will be able to find out that. Are you all with me? Clarity. So Sharpe ratio Rx minus Rf by standard deviation of X. Standard deviation of X is given. Put it here, multiply, you will get Rx minus Rf is equal to 22.5. Trainer ratio Rx minus Rf by beta is equal to 15. Rx minus Rf I know. So 22.15, just put it here. I will get my beta as 1.5 times. Clarity. Similarly, calculate beta for Y also 1.1 times. Now, sir, here the beta is 1.5 times. Here the beta is 1.1 times. Are you all having clarity? Now, sir, what is my beta? Equity NAV. Now let us find out my equity NAV change. What is my beta? 1.5, 1.1. What is my market fall? 5%. Which means how much will my fund will fall? This will fall by 5 into 1.5, 7.5%. If the market is falling by 5%, my fund will fall by 7.5%. Why, sir? Because my beta is 1.5. So it is 1.5 times more sensitive than market. And what is my mutual fund if fall in B? It is 5.5%. Clarity. So which means my NAV here will fall by 7.5%. So 70 will reduce to 64.5. And here it will reduce to 5.5%. So 56.7. So this is what is my equity NAV. Okay, wow? So my equity will reduce like this. Sir, how much will my cash will reduce? My cash will just reduce by the expenses. Sir, how much are my expenses, sir? Rupees 3 per annum. But I want to calculate for month. Correct? So 3 by 12. What is 3 by 12? 0.25. So my cash will reduce by 0.25. Very important question. Are you all with me? So my cash will reduce. So what is my opening NAV for cash? 0.71. How much is my monthly expenses? 0.25. So what is my cash NAV? This much. But what is my closing NAV, sir? My equity NAV plus cash NAV. So it is 65.21 and it is 58.95. So that is what is the closing NAV. Are you all with me? A very interesting problem. Okay, very interesting problem where the ratios are also used and the mutual fund concept are also used. Clarity. So question number 23, a very important. First of all, by reading the problem, people will not even understand what they are asking. Correct? What they are asking or how to calculate. Okay, they will get stuck. But you want to know, first reading the question is very important. If the market is going down by 5%, what is my NAV? Which means beta. How to calculate beta? Because two ratios, beta is also indirectly calculated. Clarity. Now the next one. Now the next one, question number 24. Okay, question number 24. Sir, now we are coming on to efficient. How to know, sir, which portfolio is efficient? Let us say that these are 6 securities or these are 6 portfolios, whatever be the case. Sir, these are the return of all the securities and these are the risk of all the securities. Which security I have to select, sir? Always you should see only efficient securities. How to find out, sir, efficient securities is the next thing. How to find out the efficient securities? Now see, A, B and F. A, B and F are having same return. But when you see the risk, A is having a risk of 4, B is having a risk of 5 and F is having a risk of 6. Now you itself tell me logically, for same return, will you be able to take more risk? No. If I want to choose between A and B, which one I will choose? A only I will choose. A is also giving me 8%, B is also giving me 8%, but A is giving me 8% with the risk of 4 and B is giving me 8% with the risk of 5. So why will I take high risk? So B I will not take. Similarly, F also I will not take because the risk is this. Are you all having this clarity? So B I will not select and F I will not select. This much clarity you guys are having. Super. Now, sir, uh, so I will select A. Okay, I will select A. Now let us go for the risk. Are any two securities having same risk? Yes, SIPA. B and E are having same risk. So if at all I am taking this amount of risk, I will be earning more return, right? So with B and E, if at all I want to select, I will not select B, because for the same amount of risk, I am getting this return by 8. But for the same amount of risk I am getting here, so I am going to select A and I am going to select E. Are you having this clarity? So which means A and A. C and E, you just have to keep it as it is, because more risk, more return. You cannot tell if it is efficient or not. Okay, you cannot tell if it is efficient or not. Sir, upon which securities you will select? You will select A and E, and you also have to write the reasons. Okay, I have given the solution A and F. Just one moment. I think there is some mistake. It is A and E. Okay, it is A and E. So you are going to select A and E. Okay, because same amount of risk but more return. So E you are going to select. Or for a lesser amount of risk, are you getting more? So are you getting any more than 9? So more than 9 means it is risk is also more. So do not consider. Okay. So same return. So less risk, same return. 8, 8, 9. Okay. So yeah, A and E you have to select. Okay, A and E you have to select. So next question. Assuming perfect correlation, is it preferable to invest 75% in A and 25% in C? So first what you do, first you find out what is the return of the portfolio and what is the risk of the portfolio. Correct? What is the return of the portfolio and what is the risk of the portfolio? Perfect correlation means what? R is equal to 1. Correct? Perfect correlation means R is equal to 1. So okay, so what is the return? 75% into A. So 75% into A. A is 8, right? A is 8. And 25% into 12. 25% into 12, you are getting a 9%. Okay, you are getting 9%. Now, what is the risk of the portfolio? Okay, what is the risk of the portfolio? Let us just do what is the risk of the portfolio. So, how to calculate the risk of the portfolio, sir? Weight of O square into standard deviation of O square plus weight of B square into standard deviation of B square into 2 into weight A into weight B into standard deviation of A into standard deviation of B into 1, because perfectly correlated. Okay, because perfectly correlated. Now you see this is A square plus B square plus 2AB. So I can also write it as weight A into standard deviation of A plus weight B into standard deviation of B, the whole square and root. So it will be cancelled. So I will get weight A into standard deviation of A plus weight B into standard deviation of B. So whenever it is perfectly correlated, it is nothing but weighted average. Okay, it is nothing but weighted average. So now I can do, okay, now I can do the same thing. Okay, the same thing only I did. It's the same thing only I was doing there. Okay, the same thing I did. I just wanted you to show why I did that. Okay, just one moment. Okay, clarity. So why I did this? Okay, why I did this? I just wanted you to show. You all will be thinking, sir, the formula is different, sir, because it is perfectly correlated. So perfectly correlated means it is becoming 1. So A plus B the whole square. So whole square cancel. So A plus B, same thing. Okay, A plus B. So here it is C. So A plus C. So I'm getting 6%. Now you all tell me whether this portfolio should be accepted or not. See, the risk is 6%, okay, the risk is 6%. So see, here the risk is 6%, but how much is the return? 9%, okay, the risk is 6%, but return is 9%. How much is the return? 9%. So wherever 9% is the return, see, the same 9% return you can earn by 5 risk. Here the same 9% return you have to earn by 6 risk. So it is not recommended because E is better. So instead of investing in the portfolio, invest in E. Understanding? So don't invest in this portfolio. Clarity? Instead of that, you invest in E. So it is not recommended because E is better. This is called as choosing of efficient portfolio. Sir, how to choose an efficient portfolio? Okay, same risk, more return, select. Same return, less risk, select. All others reject. Clarity? All others reject. This is how you have to see, okay, but this is how you have to see. So question number 24 is completed. Okay, question number 24 is completed. Let us jump on to question number 25. Okay, let us jump on to question number 25. Sir, Euphorium Limited, okay, sir, Euphorium Limited has been specially formed to undertake two investment opportunities. The risk and return is given. Euphorium plans to invest 80% in project A and 20% in project B. So 80% and 20%, weight is given. Sir, weight given, expected risk given, expected return given. So you have to calculate the return from the portfolio and then risk from the portfolio. The directors believe that the correlation coefficient is also 1. So 1 means directly you can do, okay, both are weighted average only. Calculate return, calculate risk, okay, calculate return, calculate risk. So similarly, question number 25, same thing you can do, okay, same thing you can do. Instead of this 3.8%, the easy way to calculate 3.8% is you can do it like this. So I have also shown you, see, alternatively. I have also shown you alternatively, it is same only 3.8%. Clarity? The same thing. If at all, if it is the R and XY is plus 1, then the formula is also this. Okay, this formula can also be used. Are you all with me? So till this you already know. Return and risk you already know. Correct? See the next requirement. Suppose the correlation coefficient is -1. How should the company invest in funds in order to obtain zero risk portfolio? Now from here, introducing new concept, minimum variance portfolio or zero risk portfolio. Let us come to the notes. Let us come to the notes, sir. Minimum risk portfolio or zero risk portfolio. Okay, wow. See, this is something that we have already learned. What will be the NAV if market is increasing or decreasing by 10%? This shall be answered using beta. Okay. Now, it is also called as optimum portfolio. Sir, what is the optimum portfolio? The portfolio where the risk is minimum. Point number 1. Sir, what is the formula for standard deviation of portfolio? This is the portfolio. Sir, if my correlation is negative, what is happening? See, correlation is negative, so this becomes -1. Correct? So this becomes -2ab. So a square plus b square minus 2ab is equal to a square minus b, a minus b the whole square. So a minus b the whole square and root cancel. So this is what is the formula for risk of the portfolio. Okay. See, I'll just give you one thing, pa. You know the formula, pa. Okay. Weight a square, standard deviation a square. Weight b square, standard deviation of b square. 2 into weight a into standard deviation of a, weight b into standard deviation of b, r of 8b the whole root. Now if my r is -1, then what will happen? This becomes minus. If this becomes minus, what will happen? A square plus b square minus 2ab. Okay, a square, this is a term, this is b term. So a square plus b square minus 2ab, a term and b term. So this is nothing but a square plus b square minus 2ab. Okay, clarity? What is a? Weight a into risk of a. What is b? Weight a into risk of b. And what is 2ab? 2 into weight a into risk of a into weight b into risk of b. This a square plus b square minus 2ab is nothing but a minus b the whole square root. Now square and root can be cancelled, so this is nothing but a minus b. Clarity. What is a? Weight a into standard deviation of a minus weight b into standard deviation of b. So this is what is the portfolio. Now whenever this is negative, I can also bring my risk to 0. Sir, risk to 0, which means whatever happens, my risk will be 0. What should be the weight where my risk is the 0 is called as optimum portfolio. Okay, it's called as optimum portfolio, which is nothing but weight of a into standard deviation of a minus weight of b into standard deviation of b is equal to 0. Let us say at what weight my standard deviation should be 0, because there is a possibility of this becoming 0, right, if it is negative. So there is a possibility of this becoming 0, because one is positively correlated, one is increasing and one is decreasing, it means it is negatively correlated. So there is chance that I can even bring my risk to 0. How, sir? Just one small example. I am opening an ice cream shop. Okay, I am opening an ice cream shop and I am opening the samosa shop together. I am opening the ice cream shop and I am opening the samosa shop together. Now, if it is summer, my ice cream shop will run. If it is winter, my samosa shop will run. Correct? So at any time it will run, my risk is 0. Why my risk is 0? Because ice cream and samosa are negatively correlated. If ice cream will run, samosa will not run. If samosa will run, ice cream will not run. Understanding? So with this, I am just giving you a small example. So same way you can put it in security also. There are some securities who are negatively correlated. If Reliance is increasing, probably some other share would be decreasing. So you have to find two negatively correlated stocks, put a portfolio and then make the risk as 0. You can do it like this. Sir, what should be the weight, sir? Sir, weight of B is nothing but 1 minus weight of A, correct? Because only two portfolios are there. If weight of A is 70, weight of B is 30. Clarity? Into delta B, into sigma B. Now, sir, weight of A into standard deviation of A is equal to, I will just multiply, is equal to 0, right? So I will just bring it here. So beta minus, standard deviation of B minus weight of A into standard deviation of B. Are you all with me? Now this weight I will get here. So weight of A into standard deviation of A plus weight of A into standard deviation of B is equal to standard deviation of B. Now weight of A common, standard deviation of A plus standard deviation of B is equal to standard deviation of B. So weight of A is equal to standard deviation of B divided by standard deviation of A plus standard deviation of B. So this is what is the minimum risk. This is what is the 0 risk portfolio. Sir, which means calculate the risk of B and calculate the risk of A, and using this formula find what is the weight. So weight of A and also weight of B. Weight of B is nothing but 1 minus weight of A. Let us say that you are getting answer 70%. So put 70% of A and 30% of B, your risk is 0. This much clarity you are having. Put 70% of A and 30% of B, your risk is 0. So this is what is called as minimum variance minimum variance portfolio or 0 variance portfolio. Clarity, it is also called as 0 variance portfolio. This much clarity you are having. So 0 variance portfolio. Sir, so just go at the notes. So what is my formula? My formula is this. Okay, my formula is this. My formula is this. And this formula will work only if R of xy is equal to minus 1. Otherwise this formula will not work. Only if it is negatively correlated, that to perfect negative correlation, only then this formula is correct. Otherwise this formula is not correct. Clarity? So if you see this question, they have given minus 1. So we can use that formula. Okay, so we can use that formula. So if you see, I've used this formula. What is the 0 risk portfolio? Weight of A is equal to standard deviation of B divided by standard deviation of A plus B. So what is standard deviation of B? 7. I've already calculated. Okay, it was already given. Standard deviation of B is 7. Standard deviation of A plus B, 3 plus 7. So 7 by 10, 70% and B 30%, which means if I put 70% of A and 30% of B, My risk is 0. Can you check? Can you check? Wait, I will just show you. I will just show you. How, sir? It is very interesting, sir. Let me calculate. Okay, ba? So if it is negatively correlated, it means weight of A into standard deviation of A minus weight of B minus standard deviation of B. Correct? Why? Because R of AB is equal to -1. Clarity? So that's the reason I have removed everything. This is what is the formula. What is weight of A? 70% into what is standard deviation of A? Standard deviation of A is 3. 3 minus 0.3 into what is standard deviation of B? 7. Correct? A is 3 and B is 7. What is 0.7 into 3? 2.1 minus what is 0.3 into 7? 2.1 is equal to 0. Clarity, clarity, super. So this is what is the answer. Okay, this is what is the zero risk portfolio. Clarity, a very important point you have learned, zero risk portfolio. Okay, it is zero risk portfolio. Sir, now the question is, if it is -1, I know how to construct a zero risk portfolio. What if it is not -1? Understanding, sir? What if it is not -1? So we have another formula. Okay, we have another formula. See, if my correlation is other than -1, so my minimum risk portfolio is, okay, just remember this formula. I am not discussing the logic for now, sir. Here it is. Okay, here weight of A is equal to weight of A is equal to actually really sorry, this should be ulta. Okay, this should be ulta. This should be ulta. Weight of A is equal to standard deviation of B by standard deviation of A plus standard deviation of B. Weight of B is equal to standard deviation of A by standard deviation of A plus standard deviation of B. Okay, so this is what is the weight formula. So if it is other than 1, then what we have to do? Here it is B, right? Do B square. B square minus covariance of AB. Okay, B square minus covariance of AB divided by A square plus B square minus 2 into covariance of AB. That is what is the formula. Okay, you just have to remember. If you solve one problem, you will remember this. Now read this question 26. Okay, so 25 is completed. Let us go to 26. Security X and Y have a standard deviation of 3 and 9. Nitish is having a surplus of 20 lakhs. Investment in these two securities, how much should be his invest in each of the securities? So minimum of the risk if the correlation coefficient is -1. Sir, if it is -1, then what you have to do? You all know. Standard deviation, weight of A is equal to standard deviation of B divided by standard deviation of A and B. So that is what is the answer. Okay. Sir, if my X is -1, so what you have to do? Y divided by X plus Y, 0.75, 0.25. So which means this 20 lakhs should be, 15 lakhs should be invested in X, in 5 lakhs should be invested in Y, because the question asks how much he should invest where. Correct? How much should he invest where? So that is what, 15 lakh you have to invest in X and 5 lakh you have to invest in Y. Sir, if it is -0.3, then what you have to do? You know the formula. Weight of X is equal to standard deviation of Y square minus covariance of XY divided by X square plus Y square minus 2 into covariance of XY. These two terms are extra, pa. And square is extra. Just a thing to remember. Okay, just a thing to remember. So this is what is the formula. Upper first you have to find out the covariance. Sir, covariance is correlation into this. How, sir? Because correlation is covariance by this. Correct? Correlation is covariance by this. So this will come here. So we have to know the covariance first. Sir, this is the covariance. Now using that covariance you can find out the weight. So weight of X is 0.839, weight of Y is 1 minus 0.839, so 0.161. Clarity. So with that you have to. So this problem I will suggest you have to do. Question number 26, you do it on your own. Question number 26, you do it on your own. One practice you should be having. Okay, one practice you should be having. Question number 26. So minimum risk portfolio. Okay, this is the minimum risk portfolio. Even this -1 you can do with the same formula. Sir, I don't want to remember two formulas, sir. I will remember only this formula. So if you remember this formula, any problem you can solve. If you remember this formula, any problem you can solve. -1 + 1. Actually, in your textbook, they are not using this formula. But I know this easy formula, but in your textbook, they are not using this formula. They are using this formula. Even for -1, they are using this formula. You do it, no worries, because answer will be same only. The only idea is that remember only one formula. Clarity. Or if you know the logic, okay, it becomes much more interesting. Upper sir, this is what is the formula. Okay, this is what is the formula. So if r is -3, this is the weight of x, this is the weight of y. Using the weight, just bifurcate how much I have to invest in x and how much I have to invest in y. Sir, if ry coxy is equal to 0, then if it is 0, then 0.9 and 0.10, and this is how you have to invest. Sir, if it is 0.6, then this is how it is. Now here the important part is weight of x itself is 1.125. See, everywhere you are getting some value, weight of x, weight of y. Here weight of x itself is 1.125, sir. Now what I should do here, sir? Which means there is no chance you can reduce the risk. The answer is that it cannot be reduced. Okay, there is no reduction possible. There is no reduction possible. Are you all with me? There is no reduction possible. Since weight of x is more than 1, risk reduction is not possible. Clarity. Risk reduction is not possible. Your portfolio will be more than your security return only. Your portfolio will be more than the security return. Appa sir, what is the minimum risk, sir? See, what is the standard deviation of x 3? What is the standard deviation of y 9? So minimum you can reduce it to 3. Invest everything in x and your minimum risk will be 3. That is what is the minimum risk. Don't go for portfolio. Even if you're putting 1 rupee portfolio, your risk will be more than 3. It's understanding. That is the reason, okay, you're getting 1.125. Clarity. So invest 100% in x. So there is no portfolio possible. If you're putting portfolio, your risk will be more than the individual risk. So it is not advisable to put the portfolio. Why, sir? Because positively correlated. Clarity. Risk is increasing. Yes. So with this you're completing this. So even an exception point we have discussed here. Okay, even an exception point you have discussed here. So with that we have all even completed question number 26. Sir, very important, lot of people don't even know this. What is called as project beta, asset beta, levered beta, unlevered beta. Correct? One more concept. Suppose this question is asked, you all will be blank. Oh sir, unlevered beta means what? See, very simple. Okay, very simple. I've even given you notes for that. Okay, project beta, asset beta, levered beta, unlevered beta. I've given you notes for that. Now sir, everyone just concentrate. I will just give you a 2-minute thing. Okay, I will just give you a 2-minute thing of how this can be done. Okay, a 2-minute thing. Sir, okay, sir, how to calculate beta, you know, sir? R of xm into standard deviation of x divided by standard deviation of market. Clarity. Sir, what is R of xm? Covariance of xm divided by standard deviation of x into standard deviation of market. Into this and this, x and x will be cancelled. So covariance of xm divided by market square. So this is what is the formula for beta, sir. Okay. Sir, how to find out the covariance of xm, sir? X minus x dash, market minus market dash, correct? Sigma into p. This is what is covariance divided by. Now, sir, for any company which is listed, first of all, market variance everyone can find out. Market, this everyone can find out. Sir, what if my shares are not traded, sir? I don't know what is my market return. I don't know what is my market return. For listed company, you can find out beta, sir. Why, sir? Because the return for the security you will know. Because the price of the security you know. For unlisted company, how you will know the price, sir? Understanding? Hello? Understanding? Hello? So, for unlisted company, how you will know the price? Sir, beta, for listed company, you can calculate. Even now you can calculate. Okay, go to your website, Money Control, download the past 10 10 days, 15 days, 20 days, 30 days return, find out the 30-day beta. Very easy to find out, okay, very easy to find out. Because listed company can be find out because the market prices are available. Sir, how to find out the beta of unlisted company? Here only I am introducing the concept of proxy beta. Sir, what is the proxy beta? We will use the beta of the listed company as the proxy and adjust to find out the beta of unlisted company. Sir, how? Sir, how, sir? See, first of all, sir, listed company is different, unlisted company is different, sir. Yeah, in what angle it will be different? Business is same, okay, sir. Capital structure is different, sir. Here it is 80% debt and 20% equity. Here it is 20% debt and 80% equity, sir. So now what you have to do is that you have to find out unlevered beta for this. You have to find out something called as unlevered beta. Then use that unlevered beta and use this adjustment to find out the beta, okay, proxy beta. So first you have to find out something called as unlevered beta. It is also called as project beta, which means beta of the business. It is also called as asset beta. Clarity. Project beta, asset beta, unlevered beta. Three are same. Okay. Sir, project beta, unlevered beta, asset beta, proxy beta, anything you can use for. What is the formula? Sir, 1 minute. Sir, beta how to calculate? From the liability side, from the asset side. Suppose I am having two projects, project A, project B. This is having beta of N, this is having beta of B. How to calculate the project beta, sir? Portfolio beta, project beta, portfolio beta. It is nothing but weight of A into beta of A plus weight of B into beta of B. Clarity. This is what is the project beta. Okay, beta of the project. Clarity. Sir, what is weight of A, sir? The project A divided by project A plus project B, and this is project B divided by project A plus project B. Sir, same thing you can even do it from the liability side. The projects can be invested in equity and debt only, na, sir. Okay, so it is nothing but weight of equity into beta of equity plus weight of debt into beta of debt is equal to project beta. Okay, this much clarity you are having. Super, sir. Sir, what is the beta of debt, sir? See, if at all, if it is a risk-free asset, the beta will be 0. But sometimes there can even be beta of the debt. For example, if your market, if the market is reducing by 10%, your debt will also reduce by some percentage. Okay, if at all nothing is given, assume this as 0. So this is called as equity beta, and this is called as debt beta. Are you all with me? Sir, what is weight of equity, sir? Equity divided by equity plus debt into beta of equity plus debt divided by equity plus debt, correct, into beta of debt. Sir, super, sir, super, sir. So this is called as asset beta. Okay, this is called as asset beta or project beta. Sir, if there is no taxes, this is correct. If there is taxes, I am also getting some tax benefits, sir. So d into 1 minus t and d into 1 minus t, d into 1 minus t. Done. This is what is the formula for unlevered beta, project beta. Appa, sir, what is the formula for project beta, sir? What is the formula for project beta? Project beta is equal to E divided by E plus D into 1 minus T into beta of equity plus D divided by into 1 minus T E plus D into 1 minus T into beta of debt. If nothing is given, then assume beta of debt to be 0. Clarity. If beta of debt is 0, then this will also become 0, right? So that is the reason. Okay, sir. Upon this beta of equity, okay, this project beta is also called as unlevered beta, and this is called as levered beta. This much clarity you are having, because this is the beta for this equity. So this is the beta for this leverage. So using that weight removing, we are unlevering the beta. So this is what is the beta for the asset, or this is called as the project beta. So what you have to do, using the unlisted, okay, using the capital structure of the listed company, First you will find out what is the unlevered beta. Then using the unlevered beta, equate here and find out the equity beta for the unlisted company, and that is the way that we have to do. Okay, that is the way that we have to do. For example, sir, how to find out unlisted beta of unlisted? First to find out the project beta for listed company. Okay, first to find out the project beta for listed company using capital structure of listed company. Then equate this project beta. Okay, equate this project beta here, equate paniko and find out this, because this itself you don't know, right? This itself you don't know. Why? Because beta of equity, you should know the price of equity. I don't know the price of equity. So equate this unlevered proxy beta and find out the beta of equity. Find out the beta of equity for unlisted company for the capital structure of unlisted company. So here I will put my capital structure and then I will be able to find out the beta. Are you all with me? So this is what is the notes for. Very interesting, sir. Unlevered beta, project beta, asset beta, proxy beta. What is the formula, sir? Liability side. Beta of equity into equity by equity plus debt into 1 minus t plus beta of debt into 1 minus t by equity plus debt into 1 minus t. In your study material, very complicated it is. Very simple. And asset side it is nothing but weight of, okay, project A into weight of project A and project B into weight of project B. Clarity? Sir, what is levered beta, sir? Levered beta is equal to unlevered beta into d into 1 minus t by e plus 1. This is the formula which is given in the study material. Don't even you see this formula. It is nothing but the same formula. Beta of asset is equal to beta e into e divided by e plus d into 1 minus t plus 0, assuming there is no debt. The same formula I'm just explaining you, assuming it is knows that this is nothing but levered beta. Okay, this is nothing but levered beta. You bring this levered beta here, take it here, you will get this formula. Clarity? So you don't remember formula and all, you just remember this part. If you remember this part, things becomes very simple. Levered beta and levered beta. Clarity? Let us see question number 27. So question number 27. Alpha and gamma limited are identical in every aspect except for their capital structure. Consider the following information and compute the equity beta of gamma limited. Sir, debt and equity of alpha is given and equity beta of alpha is given. So equity beta is given, market prices are available, and debt equity mix of gamma is given and tax rate is given. Debt is risk free. It means beta of debt is equal to 0. Sir, how to find out, sir? First I will find out the project beta for alpha limited. Okay, by using these two information, first I will find out the project beta. Okay, first I will find out the project beta for, okay, first one I will find out the project beta, calculation of asset beta or project beta, or it is also called as unlevered beta of alpha limited. What is the formula, sir? The beta of equity into e by e plus d into 1 minus t plus beta of debt. I don't have any risk, so 0. So beta of equity is given 1.3. 1.3 equity beta is given 1.3. Sir, 0.8 given. Okay, debt and equity, so 1 by 4, sorry, 1:4. So it is, what is 1:4? 4 by 5 is equity and 1 by 5 is debt. So 4 by 5 is 0.8 and 1 by 5 is 0.2. Clarity? So don't do 1 by 4, silly mistake people will do. Okay, 1:4. It means out of 5, 4 is equity and 1 is debt. So 4 by 5 and 1 by 5. Clarity? Super. So my asset beta is 1.13. Now using this asset beta as a proxy, I will find out the equity beta of gamma limited. Sir, how to find the calculate? Because asset beta will be same only if they are doing the same business. Assuming if they are doing the same business, then what will happen? So how, sir, you will know that if they are using the same business? Because they are given identical in every aspect. So same business. So project beta is also same, correct? Identical. So both are doing same projects. So which means what, sir? Asset beta is equal to, don't complicate the formula, same formula itself you write. Asset beta is equal to, so 1.13, get it here. This only you keep it as unknown. So this is the capital structure of gamma limited. Okay, which is nothing but 2 by 3. Okay, so 3 by 5. Okay, 3 by 5, which is nothing but 60% is equity and then 40% is debt. Every time debt you remove the taxes, so you will get the equity beta as 1.582. So 1.582 is the answer. Clarity? 27. Okay, 27. Super. 27 question. Now, sir, this much is okay. Very important. Okay, very important. With this, we have completed the portfolio valuation completely. Sir, security analysis, equity valuation, very simple. Sir, if it is constant earnings approach, E by KE. Dividend approach, D by KE. Dividend growth model, D1 divided by KE minus G. This is something that you already know. I hope that you already know. It is nothing but the KE formulas only. Clarity. Or if at all you want to know the logic, it is nothing but the every time, okay, it is always continuous present value. It is also called as the cash flows. Okay, the cash flows are perpetual, so it is nothing but perpetual discounting. Okay, dividend discounted perpetually. Clarity, that is what is the price. Always price is nothing but the present value of all the future cash flows. Okay, so if they say constant earnings approach, the formula is E by K. Constant dividend approach, D by K. Mostly these two formulas are used. Dividend growth model, D1 divided by KE minus G. So P0 is equal to D1. This is what you have to remember. If at all you are finding P1, then this should be D2. If you are finding P5, then this should be D6. Clarity. Super. Sir, if one growth rate is given, every year the growth is same. So this is the formula. What if, sir, growth rate are 2, sir? Till this year one growth rate, till this year one more growth rate. If like that is given, how to solve, sir? So which means for example, first 5 years 10% is the growth. So first 5 years dividend you do the present value. Then normal growth is there, right? For that you find out the price and that price you discount it. So this is what is the formula. Okay, wow. dt divided by 1 plus ke to the power t, which means the present value of the dividend plus this is the price. This is the price. Okay, this is the price for the next year, and do the present value for that also. We will see one problem for that, don't worry. Okay, that's the formula for you to notes. If you see the problem, note, you will understand. Sir, what is bond valuation, sir? What is the price of the bond, sir? Present value of all the future cash flows. Nothing. The bond coupon, everything you do present value, that is what is the price of the bond. Clarity. And the redemption value also. Sir, what is YTM, sir? IRR of the bond. IRR of the cash flows is the bond valuation. Sir, what is relative valuation, sir? P valuation. If at all EPS is given and P ratio is given, like that also you can value your equity shares. Clarity. Sir, what is fair valuation or what is intrinsic value of the share, sir? Intrinsic value is nothing but present value of the future cash flows. If the actual price is more than the intrinsic value, sir, actual price is 100, intrinsic value is 80, sir, it means that it is overpriced. Actual price is 100, intrinsic value is fair valuation. It is 80, sir, so it is overpriced, you sell. Sir, my actual price is 100. My intrinsic value is 150, sir. My fair value should be 150, but actually it is trading at 100. So it is trading less than the intrinsic value, which means it is underpriced by. So like that also question it can be asked. Are you all with me? Okay, nothing great is there. Okay, let us see one more problem. Okay, let us see 28. Question number 28, dual growth rate problem. Okay, it is a dual growth rate problem. Consider equity share in India. Current dividend rupees 3. Current dividend rupees 3. Super normal growth I am having for 5 years. Super normal growth rate is 25%. Okay, so which means for the first 5 years 25% growth. Then afterwards 7% growth. Are you all with me? First 25% growth, then 7% growth. That is how the dividend will be. Okay, that is the growth rate will be. And the investor required 14%. This is nothing but KE. Find out the price of equity under multiple growth rate model. Okay, multiple growth rate model. Sir, how to solve this problem? See, solution to 21. First of all, how to find out the price, sir? If at all different dividends are given, so different dividends, do the present value, that is the price. Or if growth rate is given, then D1 divided by KE minus G. But here both are given, so we will be using both and we will be adding. See now, sir, how, sir? First one. First calculation of dividend during the super normal growth period. Sir, year 1, 2, 3, 4, 5. My current dividend is 3 rupees, sir. Every year my growth rate is 25%. So first year I will get 3.75 dividend. Why, sir? Because currently I am getting 3. So first year 3 plus 25%. Clarity, which is 3 into 1 plus 25%. Are you all with me? So 3 plus 25% is 3.75. So 3.75. Again plus 25%, 4.6, and again plus 25%. So this is nothing but my every year dividend cash flow for the next 5 years. Clarity, for the next 5 years, this is what is my dividend cash flow. If I discounted it is dividend cash flow, I will get the present value for 5 years. But after 5 years also I will get dividend, right? What is the present value of that? Sir, after 5 years what is happening? After 5 years normal growth is happening. So what I will do, I will find out the price as at the end of the year 5, as if I am selling at year end, at 5th year end. So what is the formula for P5, sir? D6 divided by K minus G. Sir, what is D6, sir? D5 into 1 plus G. Correct. So D5 is nothing but 9.16. So 9.16, but now the growth is not 25%, now the growth is 7%, right? So 9.16 into 1.07. Clarity. So 7% now it is growing. So what is D6? See, after 9.16, okay, after 9.16 it is not growing by 25%, it is growing by 75%. So my D6 is nothing but 9.8. My D6 is nothing but 9.8. Clarity. And this value I want to find out P5. So D1 divided by K minus G. So 14 minus 7. My G is 7. Are you all with me? So what is my P5? 140. Clarity. So first year I'm getting 3.75, second year I'm getting 4.69, third year I'm getting 5.89, fourth year I'm getting 7.32, fifth year I'm getting 9.16, and fifth year if I'm selling I will get 140. How, sir? We are not selling, right? I'm just finding the intrinsic value of the fifth year. Why, sir? Because after fifth year it is normal growth, so I can calculate the price. Otherwise I cannot calculate the price. Because it is normal growth, I'm calculating the price. So normal growth 140, I'm calculating the price. Are you all with me? So all the cash flows I know, just discount. Calculation of the value of the share is nothing but discounting. So 1, 2, 3, 4, 5, all the 5 dividend and the 5th year 140. You just do the present value, you will get 92.6 as the rounded off. So this is what is the price of the share. This is 192.6 rupees is the price of the share. Are you all with me? So this is what is the answer. Okay, approximately 92.6 rupees is the price of the. So there is also something called as formula approach, sir. Same thing only. Sir, D0 into 1 plus G divided by 1 plus G1. G1 means supernormal growth. So D1, D2, D3, D4 and D5. All the 5 years doing the discounting divided by 1 plus K, 1 plus K square, 1 plus K cube, 1 plus K4, 1 plus K5. So first 5 year formula, you are just doing the present value. Sir, plus D5 into 1 plus G2, it is nothing but D6 divided by K minus G2, correct, the second growth rate, plus 1, into, because this you have to discount it to 0th year, right? So this you are discounting to 0th year, you will getting this. See, basically what you're doing here is that D1, D2, D3, D4 and then D5, and this is present value. Everything you're doing the present value, and then at the end of D5 you are calculating the price, and that also you're doing the present value. So price divided by 1 plus Ke to the power 5. That is what you're doing here. Okay, to the power 5. Wait, where is the solution? Yeah, to the power 5. Clarity. To the power 5. Same thing you did here also, to the power 5. 1 divided by 1 plus K to the power 5. Clarity. Same thing you're doing here. So this is the price into 1 divided by 1. So price doing the present value, and if you do this you will get the answer as 92.6. I will suggest you do the table approach itself. Formula approach, lot of calculations are there and people won't understand also. Okay, so logically I have explained. First find out the present value of the dividend, then find out the present value of the price, and then add on. Sometimes what will happen, three growth rate they will give. For example, how they will give is that, sir, okay, sir, first 5 years, wait, first 5 years it will be 5% growth rate, then it will be declining. Okay, then it will be declining, and afterwards growth rate will be 3%. So which means this 5 will decline to 3, linear declining. They will give linear declining. Okay, so they will give here 5 years. Okay, then 5, 4, 3, and they will give you, and after 2 years, okay, then after 7 years. So after 7 years this will be done. then 6 and 7, 5 is becoming 3. So linear declining is what you have to do, pa, okay, va? So 6th year your growth rate will be 4%, okay. 7th year your growth rate will be 5%, then from 8th year your growth rate will be 3%. So what you have to do, first to find out the present value of these 5 years cash flow, then find out the present value of these 2 years cash flow. 1 year growth is 4%, 1 year growth is 5%, okay, va? And then this is the price formula, okay. So do the price of 7th year and then discount it to this year. So that is how is the 3 growth rate model, okay. Whatever be the case, the case is simple, okay. The case is simple. The only thing is here declining is given. Actually there is a different formula for linear, but they are not testing that much and all. They are directly doing, okay, linear means usually the years and linearity will be same. If the years and linearity is not same, then there is a different formula, but that is not tested here in the CMA final. Then where it is tested, sir? Not tested, okay, ba? Don't worry. Are you all with me? Clarity. But one question is there in the study material. You see this question, okay. You see that question. With that, okay, with that we are completing, okay, we have entirely completed this. We have entirely completed this security analysis and portfolio management. Are you all with me? Hello. See, we have secured 35 to 40 marks, okay, ba? Around 40 marks, sometimes 40 is asked, sometimes 35 is asked. MCQs are also asked from this, and it is very important, okay. The section A we have completed in the previous video. Section B, security analysis and the portfolio management, if you combine these two, 60 to 70 marks is the weightage, okay. 60 to 70 marks is the weightage that is covering in these two chapters only. Are you all with me? Super excited? Hello. Okay, so with this, okay, with this we are completing security analysis and portfolio management. Just to give you a small revision, sir, revision ke revision, so just to give you a small revision, mutual fund is very simple. How to calculate the return of the fund, how to calculate the annualized return, how to calculate the NAV, only these 3 problems are possible. And then 3 ratios in mutual fund: Sharpe ratio, Trainers ratio, and then Jensen's alpha. Clarity? So using that blah 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 you have to do. So risk return, risk of the security and return of the security and risk of the security, return of the portfolio and risk of the portfolio. Clarity? So how to find the expected return? Sigma x by n. Expected risk standard deviation, sigma x minus x dash the whole square into probability root. Clarity? Sir, risk return of the portfolio, weight of A into risk, weight of A into return of A plus weight of B into return of B. If C, then plus weight of C into return of C. Sir, risk of the portfolio, sir, weight of A square into variance of A plus weight of B square into variance of B plus 2 into weight A into standard deviation of A into weight B into standard deviation of B into correlation coefficient between A and B and then whole root. That is what is the standard deviation for A and B. Sir, A, B and C, A, B and C, don't worry about, okay, ba? So weight of A square into standard deviation, weight of A square into standard deviation of A square plus weight of B square into standard deviation of B square plus weight of C square into standard deviation of B square plus 2 into weight A into standard deviation of A into weight B into standard deviation of B into correlation coefficient between A and B plus 2 into weight of B into standard deviation of B into weight of C into standard deviation of C into correlation coefficient between B and C plus 2 into standard deviation of A into weight of A into weight of C into standard deviation of C into correlation coefficient between A and C, the whole root. Are you all with me? Hello. Don't get scared and all, okay. Everything is very simple. In your book there is also one more method called as matrix method calculation, okay. I don't believe, because even in the calculator, because in the matrix you have to calculate every time. In the formula, just in one m plus you can calculate. So I believe in formula. Are you all with me? Clarity? Okay, because in matrix you have to calculate each and every number and then you have to add each and every number. Calculation itself will take you ages, okay. So just to write the numbers and do equal to, put it in the calculator, m plus m plus m plus m plus, and then MRC, you will get the answer. Clarity? So that is what is the risk return. So risk return like correlation coefficient and covariance you should know. What is correlation coefficient? Covariance of AB divided by standard deviation of A by standard deviation of B. Okay, correlation of AB divided by standard deviation of A into standard deviation of B. Sir, what is covariance of AB? Mean deviation of A multiplied by mean deviation of B into probability. Correct? X minus x dash into y minus y dash into probability. Are you all with me? If no probabilities, then divided by n. Clarity? So that is what is the covariance. Okay. So next we came up into minimum variance portfolio. If my correlation coefficient is -1, then weight of A is equal to standard deviation of B divided by standard deviation of A plus B, and weight of B is equal to 1 minus weight of A. Sir, if correlation coefficient is not minus 1. Then what is the minimum variance? Now it is not 0. Okay, now what is the minimum variance portfolio? Your minimum variance portfolio is equal to weight of A is equal to standard deviation of B square minus covariance of AB divided by standard deviation of A square plus standard deviation of B square minus 2 into covariance of A into B. Are you all with me? Hello. So repeat again. See, weight of A is equal to standard deviation of B square minus covariance of AB divided by standard deviation of A square plus standard deviation of B square minus 2 into covariance of A into B. Covariance of AB. Clarity. So this is what is the minimum risk portfolio. Are you all with me? Then if the correlation coefficient of +1 -1 perfectly correlated, blah 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 blah, lot of things are there. Then how to calculate beta, sir? Beta is equal to correlation between the security and the market multiplied by standard deviation of the security divided by standard deviation of the market, or covariance of the security and the market divided by variance of the market. Are you all with me? So that is what is the beta of the security. Clarity. Okay, sir. So beta of the security. So total risk is bifurcated into systematic risk and unsystematic risk. Systematic risk is nothing but beta into standard deviation of the market. Okay, standard deviation into beta into standard deviation of the market. Because systematic risk means how much is the market specific risk. Market is increasing, my share will increase. Market is decreasing. So out of the total risk, what risk is associated to the market and what risk is associated to the company. So unsystematic risk is associated to the company. Systematic risk is associated to the market. Clarity. Are you all with me? Super, sir. Okay, everything we have done. So portfolio beta, everything we have done. So beta, optimum portfolio also we have done. Okay, project beta, sir. Project beta is nothing but equity beta into weight of equity plus debt beta into weight of debt. But here in debt you have to do 1 minus T. That's it. Capital structure. Sir, then proxy beta use pantu you have to find out the equity beta. That is what is levered or unlevered beta. Are you all with me? Clarity. So this is nothing but levered beta. Okay, this is nothing but levered beta, and this is nothing but unlevered beta, and this is nothing but levered beta. This much clarity you are having. Equity valuation nothing great. Bond valuation present value of the future cash flows. Okay, future cash flows. In equity valuation mostly dividend growth model only will be tested. Okay, with this we are 100% completing. Okay, we are 100% completing this security analysis and portfolio valuation. Okay, so if you have enjoyed this video, I would want you to put a comment, okay, like how helpful this video was, and all the very best for the examination. Okay, all the very best for the examination. See you all on the other side. Okay, see you all on the other side. Like you guys should become qualified CA and come to me, say me a hi and meet me. Are you all with me? Okay, so let us have a break now, and then we are going, because we have a lot more to cover. Okay, so we have a lot more to cover, but 60% is already completed. Okay, 60 to 70% weightage, sometimes 60, sometimes 60, 70. So this is something which is covered. Are you all with me? Okay, so section A and section B, the important, okay, the mammoth is completed now. So if these two are completed from your side, you have to be relaxed. Okay, you have to be relaxed, because the other things will not take much time. Are you all with me? Okay, so tata, bye bye, thank you very much. Okay, see you all on the other side. Bye.